Good morning, everyone, and welcome back to the ECB Forum on Banking Supervision. Thank you for joining us today here in Frankfurt and online. It is my great honor to introduce our first keynote speaker, Pascal Donohoe, Ireland's Minister of Finance and President of the Eurogroup. Minister Donohoe will speak about shaping financial regulation in an era of distrust. He will be ready to answer some questions at the end of his speech. Minister, please.
Good morning, ladies and gentlemen, and thank you very much to the organisers of this conference. And I understand this is the 6th forum now on banking supervision. It's a real pleasure to be here in Frankfurt and to be on this stage and to speak about what is a really important theme. And that theme of resilience in times of disruption is not only so important from a banking and regulatory perspective, it is also from a political perspective the great challenge of our time. And speaking here in this building and speaking here in this institution, so many of you will be aware that our system here of central banking in Europe and the way we think about financial regulation has many different origins and has been drawn from many different schools of thought. And I understand in the very early days of the ECB and in its precursor, the EMU, the work of Walter Yuccan was foundational. And central to his work was the understanding that a stable and well-functioning market economy needs to be underpinned by a strong legal and institutional framework. He wrote the following, that freedom in the economic sphere is only possible if it is bound by order. And today, we are now confronting a world in which various different forces are now under play. We can see increasing disorder, defined by geopolitical tensions, defined by economic fragmentation. However, we must be cognizant that disruption to the status quo presents opportunities as well as challenges. And the key to all of this is how we can balance the trade-offs between risks and opportunities that disruption will always present. And that's why today's forum, I'm sure, is a really valuable opportunity to reflect upon the various challenges that are inherent in this moment. And when we look back, we and you should be really proud of what has been achieved. As the first pillar of banking union, the establishment of ECB banking supervision, and in particular, the creation of the SSM, was a landmark moment in the transformation of the euro area. It's now firmly embedded as a symbol of the euro area and the economic integration that has happened. But of course, it's far more than a symbol. It's a critical institution. And this was evidenced to me only on Wednesday, when we had the great pleasure of welcoming Claudia, the chair of the SSM, and indeed the head of the SRB, to the Eurogroup meeting in Brussels, where we had our biannual engagement between all ministers and Claudia. And the quality of that dialogue and the nature of that engagement has changed so much, reflecting the different roles that are present in that room. And while at that time the establishment of ECB banking supervision was a very difficult decision, we now know that it was the correct decision then, and it's the correct decision now. It was the way in which we strengthened our banking and financial system, and this resilience has been our strength, and it's vital that we continue to build upon it. So when we talk about supervisory practices today, it's good to remind ourselves of the actual need for banking sector regulation and to revisit very briefly the past events that shaped its current form. We can all remember the very dark moments during the crisis. We remember what this meant for our banks and for their future, and we still feel the impact of that here today. But the aftermath of that financial crisis is a shadow that's still very much with us because of the role it played in trust, the role it played in the erosion of trust in institutions, all of the many, many political effects that had, and the very hard work we've all done and the journey that we are on to reclaim that trust, to rebuild it month by month, year by year. And central to all of this, but at times in the background, has been the role of global cooperation. It was central to the progress we have made with regard to trust by enabling us to reshape banking supervision together. And at the level of the European Union, this reinforced the need for the creation of banking union. We have a lot more to do, and I'm very, very clear on that. But we have taken steps, and the progress that has been made, particularly with regard to supervision, and the work of all in the banking sector in responding back to that, has been instrumental in promoting financial stability, protecting the taxpayer, and continuing our journey towards the single market in banking. And as we're all aware, one of the key objectives in our efforts, if not actually the key objective, was to break the negative feedback loop between banks and the state. And in my view, progress on that relationship was and will be the cornerstone of how we rebuild trust. And it therefore would be remiss of me not to acknowledge the very strong performance of our banks under the supervision of the SSM and their very clear resilience, which has been improving steadily in the last decade. We have come a long way, and since then we've shown our ability to weather many different shocks. But we're now in a new world. We're now looking to the future. And we know that in the past and in the future and now, global cooperation has been critical to the regulatory environment we are now in. Maybe even it's the key ingredient to effective regulation, seeing financial stability as a global public good. So if we want to live in that world, if we want to make the case for protecting an open global financial system, then I contend that part of the journey of trust that we have to keep on is looking at how those global standards in turn have helped us protect financial stability. In the absence of that, we face a different journey. We face a journey of regulatory fragmentation, of arbitrage, and of a playing field that keeps on changing. Ultimately, that could just create further risks to the consumer, to stability, to investors, and to the kinds of services that we're able to provide. And as we think about our way to navigate our way through that kind of change, my strong view as a Minister for Finance and as President of the Eurogroup is that the independence of our regulators has been fundamental to the progress that we've made. This independence has allowed us to maintain a financial stability prerogative, while also at times responding back to changes that need to be made as economic conditions also evolve. And just as the independence of the ECB and all central banks in setting monetary policy is crucial, similarly, the independence of the supervisory role of the ECB and SSM is also fundamental. We're living in a world where rapid change is increasingly woven into the status quo, where regulation, the nature of policy, is questioned against a backdrop of change. But as we engage in that debate, we have to make the case for the value of the foundations that we have built and for the role of cooperation and how both coming together enable us to have the best possibility of preserving trust. And as we look at our efforts to do that, I would suggest there are three broad areas in which even greater cooperation and collaboration can protect that journey of trust and maybe even accelerate it in the future. First, transparency and clarity of message is crucial. Economic actors, governments, politicians, and above all, the people we serve, our citizens or your customers, must understand the steps that we are taking, and they must understand why. Second, as I said a moment ago, preserving the independence of our regulators, supporting that foundation, in turn, I believe, will help with the deepening and preservation of resilience. And thirdly, we must demonstrate the role of the banks, the role of our private sector in how they sustain growth and how they can drive growth further in the future. If we can do all of this, instead of a crisis feedback loop, we might have the prospect of better developing a virtuous circle. And in turn, speaking in the institution that I'm now in, this might in turn give us the best ability of maintaining a stable regulatory system and also the orderly functioning of markets. So, as I've said again and again, that concept of resilience is the foundation of a sound and stable banking sector. However, that does not mean that we should not also be focusing our attention on ensuring that our banking sector is globally competitive and is fully availing of its growth potential. We need to consider if the EU banking system is meeting the needs of our economies in the simplest and most competitive way possible, in a manner that ensures financial stability and resilience. In a world of disruption, with instability in our political and economic landscape, I would argue that this creates a greater impetus, should create more momentum, on the necessity of our banking sector to adopt, to innovate, and to contribute to the financing of the real economy to the best of its ability. Getting this balance right is critical, especially in the light of the many challenges we are now confronting, not least what's happening politically, but also the urgency for Europe to grow quicker, to tackle our structural issues, while also financing the investment and expenditure we will need. This does not translate to an argument for the EU to join in some kind of race to the bottom when it comes to financial regulation, but we do simply need to examine what can we improve, what can we streamline, and what can we simplify. Our goals should be effective regulation, efficient regulation, and supervision where working together underpins a stable and resilient banking sector. Getting the balance right between regulation and supervision without stifling innovation is a balance that governments are considering and engaging with each other on. Otherwise, we run the risk of falling further behind our global partners in terms of competitiveness and productivity. And the governments themselves have much to do. Achieving deep and liquid capital markets, together with a well-functioning banking union, is the work governments need to continue at. Because these are the key ingredients to this prerogative, and they provide a greater impetus for us to drive forward with the Savings and Investment Union while we continue with the hard work on our banking union. We know that by doing this, this will strengthen European integration, it will develop our sovereignty, and it will deepen the foundation of the euro. So I want to conclude on that point by reiterating that stability and reliability of the euro area is critical, and it is a vital attribute in an uncertain world. And the work of the SSM in the sphere of financial regulation plays a very important role in maintaining this stability. Just as the crisis of over a decade ago provided the political will to deliver major structural changes within the euro area, the current environment should also serve as a driver to finish what we started. Those bold actions are clear. Our work on capital markets, our work on the Savings and Investment Union, and further work on banking union. In this increasingly uncertain world, I'm clear that what we need to look at is the role of regulation, recognising our independence of our institutions, knowing that the EU needs to remain competitive, but we need to find ways to boost innovation, simplify regulations, and look at the debate that is evolving regarding how we can work together to do this. In my role as Minister for Finance, I can appreciate the stark challenges that are involved in taking difficult decisions to secure the financial future of economies, of banking sectors, and also to be aware of where we have come from. During my time and in the work that I do, I have fully supported the return, for example, of the Irish banking system to private ownership following government intervention. This has been a long and arduous road with many difficult decisions along the way. But this is the kind of journey that we need to keep at, to finalise our banking union, to enhance competitiveness, to maintain trust, and to finance the future of Europe and its citizens. President John F. Kennedy was fond of quoting an Irish author who wrote that as an adventurous boy, when he and his friends would come across a wall that looked too high, they'd throw their hats over the wall, so they'd no option but to find a way over it. So we have to throw our hats over that wall and commit to delivery as political leaders, as leaders within our banking sector, and as leaders of the great project of the European Union, to find a way in that we act with responsibility, but never, ever run the risk of complacency. Thank you. Now, I said I would take a few questions, but I can't remember. Yeah. What format would you like to do with it?
Yes, if somebody has a question in the room, please raise your hand. We have some microphones that we can deliver. Anybody wants to break the ice?
Hi, my name is Carlo Boffa. I'm a journalist for Politico. I have two questions. The first one is that some central banks have made proposals on simplification that entail changing legislation on capital charges. Do you think this is feasible for Europe? And do you think, how long do you think it's going to take to make these changes, given that you have experience, for example, with the CMDI package that is taking many years? Do you think this time, in the spirit of simplification, is going to be a bit simpler? And the second question, given that you are here in Frankfurt, maybe quickly, do you expect to leave Frankfurt with a letter to start the process for the succession of the Vice President of the ECB? Thank you.
Excellent. Thank you both. Thank you for those two great questions. I'll begin with the easy one in terms of the future of our banking sector, and your question there. So firstly, the point that you made there about CMDI, you are of course correct. It did take time, and I remember very, very clearly the many meetings within the Eurogroup where we had to negotiate a political agreement to encourage the package on the crisis management framework to be proposed by the Commission. But that's now nearly agreed. And this will be the first step forward in banking union that has happened outside of an acute financial difficulty within Europe. And when I talk about the progress on banking union and the work that we have done, I sometimes think that we underestimate the value of each step because we have taken these steps over many, many years. So the crisis management framework package, I hope, very, very shortly will be completely agreed and implemented. And many of our colleagues within the European Parliament who are here today, in fact I see Amanda Tinagli, was the rapporteur for the CMDI package within ECOFIN. And the European Parliament did great work in trying to move forward a very, very complex file. So progress has been made on that. In relation to your point then regarding financial charges and what different central banks might recommend, so I understand and know that work is underway here within the ECB, chaired by Vice President de Guindos, and when they bring forward that report, it will give us all an opportunity to consider the recommendations. Do I believe we'll be able to make progress on them? Yes. Do I think that will take time? Yes. But we need to ensure that time is shorter than it has been in the past. And that's what we're going to try to do. In relation to your second question regarding the ECB, so we had a discussion on this in the Eurogroup meeting on Wednesday, and we have outlined to governments what will be the process with regard to the filling of that post, and I would anticipate that process will be commencing soon.
Hi, thanks for being here. I'm Catherine Sander, I work for the ECB. Ever since I started working in finance, which was 2011, which makes me a baby compared to the experience in this room, we always talked about competitiveness, market fragmentation, but it doesn't seem like we're really jumping forward. So how real and quick can we advance in tackling market fragmentation in Europe? Thanks.
So I think you make a fair point. And there are people in this room that will know far better than I do all of the challenges that are involved in cross-border market integration and the degree to which that is politically at times challenging. And we have some experience of this in Ireland as well, as a small open economy with a number of pillar banks. Do I believe we can make further progress on it in the future? So firstly, I think we need to have a more open discussion regarding what are the costs and consequences of fragmentation within our banking sector and consider that in a new way. And we are going to have that discussion within the Eurogroup in December to consider this matter again. Because I'll just simply observe that I am, and many other ministers are aware of how much change has taken place around the banking system of the European Union and the breadth of growth in other global banks. We need to be more considered regarding what that can mean and what that does mean for the future of the European banking system. So I acknowledge it's a difficult area. We're going to consider that again in December. And as the package on the crisis management framework nears conclusion, and it's nearly there, we'll then consider what kind of future options are there regarding how we can make more progress on the different elements of banking union. Sure.
Thank you very much. Jasmin Osman from Handelsblatt in Germany. You mentioned that we need regulation that boosts innovation. So would you go so far that you say it should be the task of supervision authorities to care for the competitiveness of the banking sector, or is this idea going too far?
So I said that regulation plays a role in the environment that then leads to innovation. But I was at pains to say in my speech that the foundation of all of this is the independence of our regulators and the role they play in financial stability. And maybe it's because of the experiences I've had myself, that will always be the number one job. Do I believe that regulators should have a mandate with regard to competitiveness? I believe the mandate they have now is the right one. And I believe if they get the long-term framework right, from a stability point of view, that's the key thing to in turn to allow the private sector then to prioritise innovation. So I don't support a change in mandate. I believe the role of regulation, first and foremost, has to look at stability. But as I said in my speech, I do think it's appropriate that we have a look at how we can have that regulation designed and implemented in a way that's simpler, that clearer, that doesn't create costs, and that contributes to our banks being able to be regulated in a more efficient way. Great. So, thank you.
Our first panel of the day will discuss the digital revolution. Are banks watching from the sidelines? The panelists will dive into the topic of the day everywhere: digitalization and artificial intelligence. Are banks and supervisors keeping pace with developments and risks? Let's welcome our moderator Jasmin Osman and the panel members to the stage. Jasmin is a senior journalist at the Handelsblatt, covering banking and insurance. She has covered the SSM since its beginnings in 2014 and authored a book on what everyone should know about banking supervision. Jasmin will introduce the panel members and invite you to join the Q&A.
So, welcome to our panel discussion on digitalization. Well, I don't have to tell anyone here in the room how much digital transformation is shaping the financial world, but how far have banks really come so far? Are they driving innovation, or are legacy systems, complex regulations, low budgets still holding them back? And ultimately, will digitalization strengthen the sector? Or will it expose new vulnerabilities? And I'm delighted to be joined in this discussion with very distinguished experts. I start with you, Francesca. You are CEO of Revolut UK, and your career spans positions in major traditional banks like Barclays and Deutsche Bank, but you've been also founder to Molo, the first digital mortgage lender in the UK. And now you're a part of the most valuable tech company, as I learned, in Europe, Revolut. So welcome. Ray Pinto, you are Senior Director at Digital Europe, and that's Europe's leading association for the digital industry. You have among your members big techs, traditional industries, also banks. And Arthur, you're Deputy Chief Executive of the Hong Kong Monetary Authority, and you play also an important role in global banking supervision, as you are a long-standing member of the Basel Committee, and you are co-chairing the committee's policy and standard group, as I learned.
Yes.
So before we start the discussion, I would be happy if you engage also in the panel in two ways. So I prepared two little polls and would ask you to answer the questions to enrich a little bit our panel. So the first poll question would be, what do you think is the main barrier to faster digital transformation in the financial sector? And before I tell you the second question, I will mention that if you do have questions, feel free to send these questions digitally. So if they fit well in the discussion, I will ask them also during our panel session before we have the Q&A answer. So then the second question of the poll would be, how would you assess the impact of current regulation, like DORA, MiCA, or AI Act? So, would be great if you participate. And then let's start with our panel discussion first. So the title was, Are Banks at the Sidelines? Yesterday we learned some interesting numbers about what the digitalization means in the banking sector. I remember that I think Autonomous presented a poll that 40% of the banks say that more than 50% of their data are still in the cloud. And I learned that Sharon mentioned that 58% of the banks use AI already today. But as Andrea Orcel put it, it's not important how much you spend, it's even more important if you spend it right. So Ray, you have an insight in many companies. So what is your impression of the digitalization status of European banks? Are they leaders among industries or laggards? How happy you are about their state?
Look, thank you, Yasmina, very much. And I want to thank the ECB for inviting us to speak and my fellow panelists. I have been in this business for a long time, and I remember in 2010, no banks were going to the cloud, and it was impossible then to do so. The regulators stepped in, and you have things like DORA that has now facilitated that, and that speed, which is creating innovation. You mentioned members that are part of Digital Europe. Yes, there's banks, there's stock exchanges, there's payment services, but there's 45,000 innovating companies here in Europe, and they're creating massive innovation. And so I would like to think, and I think everyone knows this, you all have your payments on your phone, you tap your payments, you connect to services, you manage your wealth. If you look at some of our big members, CaixaBank is investing $5 billion, and they're doing so to have very advanced customer services that are going to be AI-driven and cloud-based driven, right? You have Santander Bank that works with a company called Ripple that allows wealth management here in Germany. I don't know how many people are using it, but quite effective. And ING is also using blockchain technologies. So I think what we're seeing now is banks are at that pivotal point to decide, are we going to let this pass us by, or are we going to move quickly? And I think, considering who's sitting to my left, banks are moving very quickly, and that's a good thing. Now, what we'll get into later on, and not the regulations that the minister and excellent speech was outlining, we'll be looking at some of the very focused digital regulations, and what is the interplay with that now in this kind of new territory of creating digital services.
Well, yesterday I learned that regulators are paid for being more pessimistic. So let's check this. Are you happy about the status of banks as well?
Okay, first of all, let me also thank ECB for asking me to join the panel. I know that I'm the only bad guy on this panel, so I'm supposed to say the bad things. But seriously, before I answer the question, let me put this perspective to the audience. We always feel the banks are moving slow, but that's mainly because banks are not just any normal commercial operations. When banks fail, it creates repercussions. So President Donohoe this morning talks about the need for stability. That's exactly why regulation exists, to ensure stability. So the banks would not just fail that easily. So when we look at how quickly banks are adopting these kind of technologies, we have to always bear that in mind, that you might actually feel that they are slow, but don't do the following. Today, when we want convenience, we go to banks and say, how come you're so slow? But when things turn bad against you, then you switch to the other side and start criticizing, hey, how come you did not protect my interest? So it's very important to strike that balance. That's a very important point to put up front. Now, you asked me whether banks are too slow. I wouldn't say that. You mentioned the figure of 58% of the banks in Europe are already adopting AI in some way, some shapes and forms. The corresponding numbers in Hong Kong, by the way, is 75%. So by comparison, probably we're moving slightly faster. But nonetheless, this is a fast-moving space. So I don't think with those kind of numbers you can really say that banks are moving too slowly, bearing in mind the first consideration that I've mentioned.
Well, I think one of the larks among banks in digitalization is surely Revolut. So maybe you give us an impression what digitalization means for you, how much you are spending, for example, on AI, and what are the main areas where you digitalize or using AI to improve your business.
Yeah, no, thank you, and it's a pleasure to be here. So very happy to share perspective, and we are all kind of trying to contribute, right, to the wealth of the financial system. So I think what I would say, well, first of all, I would say that whilst Revolut is a bank in most countries, yet we are a special type of bank because we were born through the digital age. So in a way, we are digitally native. And I just say that because I spend my life in other type of banks, and so I can compare and contrast a lot, and probably that's where I think there are a lot of the insights that I'm having now come from, right? So yeah, so given our nature, so we are being really digitally native, of, you know, having built everything from scratch, we try to adopt innovation quickly. And I would say the key differentiators I see when I contrast compared to what I've seen before is that there are probably 2 or 3 dimensions that make a difference in the ability to be innovative and to be disruptive, right? And one is clearly, it is a culture, it's the agility of ability to what also Sal was saying yesterday. Today it's very difficult sometimes to plan for like 5 years. You need to have the ability to go in have a clear direction, but then iterate and evolve. And that sometimes difficult to do in a bank. The second one is being very data-driven. So incredibly data-driven. You need to have the data infrastructure to be able to do that. And so, and that's something that from what I experienced before, sometimes even really difficult to have the clean data layer or data stack, right? So, and that's why I think the cloud is helping with that. And then in general, having a very solid infrastructure that is new and modern, right? And this is happening across the banks.
How much do you spend on your infrastructure? So what is your technology investments in percentage of your costs?
Well, I think a majority of our cost is technology investment, but because for us, everything is tech-driven. So it's very embedded. So it's very difficult to split and give a number. But I would say we are investing a lot now also in AI. And to your question before, is kind of invasive, right? So what we do in AI is, I would bucket into 3 areas mostly. One is customer facing, so clearly the typical customer interaction. I think right now our customer service, 80% of the inquiries are already answered by our AI bot, which is continuously evolving, which is quite a big portion. And second, there is a lot about defense, and that's where I think makes a difference. And I do think that innovation goes hand in hand with trust and security. Defense, I mean, like fraud screening, transaction monitoring, sanction screening. I would say, and fraud prevention. And today, I would say it's almost impossible to be at par with criminals unless you you are investing in very advanced AI and machine learning technology, right? And so that's why it's almost a call for action. You need to be innovative. So that's probably the biggest area of investment for us in AI. And there are a lot of other use cases which we are mostly experimenting around, for example, even marketing, communication, legal, and all of that. So we're doing, but the way we adopt AI is across the board. So we do pilot, iterate, and evolve, and because from top down, is seen as a priority. So in everything we do is involved. And I really share the view that was mentioned yesterday by Ursel, which is, the problem is that AI is not a tool. It's different ways of working. So you need to have the mindset, the ability, and the flexibility from a team point of view to embrace it in a way.
Okay, thank you very much. So, well, I think we do have the results of the first poll, and it would be great if you could see the result.
So you get a drum roll?
Okay.
I see there.
Okay.
There, yeah.
So I see the leading impediment is corporate culture and mindset, followed by regulatory complexity and shortage of digital experts only on place 3. And obviously there is enough budget to invest. So what do you think if you see this results? Is this matching your expectation or your experience? But at Revolut, probably not the culture.
Probably at Revolut, no, but it's really an interesting question, and please, it's really interesting to see what this audience thinks first. So from my experience, I say broadly, yes, and some areas are surprise. For me, if I had to rank it, I would say definitely culture and incentives is number 1, and that's for me is a fact. So if you in a company, everything happens when you have the right direction and at least supervision and KPI set on it. And I think in a lot of big banks, not a Revolut, right? So, but that's where I can compare contrast. In a lot of banks, sometimes it's not really pushed from the top, and honestly, driving innovation drives cannibalization of the existing business sometimes. And so you need to create incentives environment to A, make mistakes, but second, to cannibalize existing business for something that, for building the future, right? So that I would definitely resonate with me. I would say that one thing that I see missing the list is legacy infrastructure, because I think that's a deterrent sometimes. I don't know if you share this, but I do think, for example, we forget that even just to build any automation, you really need to have clean database and single customer view and all of these things that sometimes are still not there. So I think the legacy infrastructure, the technology, data infrastructure is something I would add to the list.
Yeah. Yasmin, if I may come in, I'm really impressed by that answer. Because if you put the same questions in Asia, I think the fourth one would come first, cost. And then probably mindset would come third or fourth. But in our experience, actually, the main thing that's really pulling any initiative back is whether to have the right mindset to do it. If I may put the following perspective to the audience, traditional banking model is pretty much a transaction-based model. So whatever you put in terms of buying a new system or creating a new system that's AI-based, the natural questions that the management team and the board would ask is, am I creating enough transactions subsequently to justify the expenses? So that becomes an expense consideration, not an investment consideration. But in this world, when AI, DLT technology is actually not easy to build, and it's quite fundamentally changing the way banks actually operate, if you really consider those as expenses, it doesn't help you. So mindset is important, that you really think about those kind of things as an investment item rather than an expense item, and quite fundamentally review your business model. Going forward, is it transaction-based or is it data-based? I don't think that question is being asked enough times in a lot of banks, probably because of legacy issue that Francesca was talking about.
Yeah, let me add to this, because I agree with you on legacy. Yeah. And definitely on cost, because if you're looking at distributed ledger technology, if no one's using it, why would you be investing in that? There has to be incentives that there is wide adoption of these technologies. But let me pick up on regulatory complexity. We have been looking at a real piece of regulation, which was the GDPR, right? It's 7 years now since it was adopted, I think, 7 or 6 years. And even to this day, there's still many questions about its implementation. They're still trying to create guidelines, right? But now we're in a world of ex-ante regulation. So this is regulation that is trying to predict what are the ills, what could happen, what are the bad things. There's studies, there's CNN news reports, there's isolated incidents. But I think we now have a very robust piece of legislation called the AI Act, which is on the table. And it is moving extremely fast for its implementation. No one can ever say to the regulators, you're moving far too slowly, right? They're moving very quickly. And I think now what we're seeing is a huge potential of fragmentation for this act. There's a lot of the member states that are implementing it in their own kind of different way and flavor. There is standards that haven't even been developed or guidelines that need to be developed to help people try to implement regulation in areas that is not even crystal clear in their own minds, which is creating huge costs. So that's fine if you're a big bank, it's probably not fine. But if you're a small company, the initial impact assessment that for the AI Act that was done before all of this started by the European Commission said that the cost of implementing the AI Act would be 300,000 euros. Now, how do you do that if you're a small business? Tell me. So we are at an inflection point, I think, where there could be a dramatic slowdown of such innovation here in Europe and development of these technologies and adoption that we haven't seen because that wasn't there. So I think regulatory complexity is a huge risk.
Well, that matches with a talk I had with some COO of a bank. And he said, for AI, I do have 50 people, difficult to find, high to pay. And a third of them is dealing with the implementation of the AI Act in categorizing the levels of AI security. And that's pretty far too much. So Arthur, you're looking a little bit from outside also on the situation in Europe. So what is your impression? Is this a sound share if a third of the people is on AI is doing business with regulation?
Well, I think the point about regulatory complexity is always a balance between how prescriptive you want the regulation to be and how much efforts you put in after the regulation is put in place to interact with the industry. So, and it's not binary. That policy choice is not binary. It's a combination of regulatory certainty as well as engagement subsequently. So by comparison, I would just use Hong Kong as an example. Our first AI regulation came out in 2019. It's principle-based. It doesn't really contain a lot of details. And therefore, the industry would have to find a way of interacting with us on a very interactive and iterative basis to find out what exactly do we mean in practice. Yeah. So, and then when generative AI came on in about 2 years ago, we actually took a fresh look at that 2019 principles, and they were still valid. And so the beauty of having a principle-based regulation is that it lives through different phases of development. But then, because of the lack of clarity in the regulation, you do need to put in place mechanism for interacting with the industry in a highly iterative process. So we did two things. First, in 2016, we had a sandbox put in. A sandbox is to allow banks to really, and tech firms, to really try out ideas. And we promised them, if you fail, you won't face like 20 on-site examinations next year. We promised that. And actually, throughout the years, we had like almost 400 test cases. About 20–30% of those did not graduate, so they fail in the sandbox. And we never actually create any negative supervisory response function brought to bear on the banks. So that's the first thing. That basically is to reduce the cost of failure of trying out what exactly do we mean by those principle-based regulations. The second thing we did was in 2019, we put in a chat room. So tech firms and banks, and even tech firms alone can come to us and ask to talk to us, have a 2-hour sessions with us, talking through some of the ideas, what would be our immediate supervisory responses, and what are the things that they need to focus more attention to. Up to now, from 2019 up to now, 6 years, we have almost 1,000 chat room sessions with different people. And they all came back and said that, oh, that's great to have that kind of a very iterative process. We even brought in other regulators in Hong Kong in the chat room sort of sessions. So you really need to do that, but that's very resource intensive, honestly. Imagine 1,000 sessions with tech firms. 60-something% of those requests were actually from tech firms alone, not involving financial firms. But we still entertain that because we set all those principles, and it's only incumbent upon us to explain to the market what exactly do we mean, what would satisfy us, rather than putting it in detailed regulations.
So may you tell me, I think you cover or supervise around 100 firms. Yeah. So how many people are dealing with these chat rooms? And because you mentioned that it's very intensive.
Well, on our part, I do have a team dealing with SupTech, just a few people, but the resources actually not in the central team. The resources are in the risk experts, that when they were asked a particular usage of AI, they would need to round up the right people in the risk teams to come forth and spend the 2 hours with the tech firms to tell them this is how we look at this technology application. So it's very hard to put a number to it, but I would say it is resource intensive for the regulators. But nonetheless, it's more, I would say, agile in our response to where the market's heading.
Yeah. And if I may add to that from banking point of view, because we have a similar approach has been adopted in the UK. Probably everybody knows. So there is an AI even more extreme. There is an AI regulation. The regulators have decided to effectively not regulate this rigidly right now, but engage with industry. So it's the same approach. And so there's an FCA sandbox. There is a task force set up by the Bank of England, and we are really engaged on that. And ultimately, the regulatory rule has been that they put the responsibility on the senior managers. There's a very strict senior manager regime, and so effectively it's about delegating and the opportunity and the challenge and the responsibility, and that's working very well for us. It does require an extra effort from the industry to engage, right? But it gives us a little bit of safety net to also experiment through the sandbox. I see that from a regulatory standpoint, there's a lot of learning, so mutual learning, effectively. And so that's, from an industry point of view, I can reply, it's very welcome, especially because the use cases are still very fluid. And it's probably the better way to shape a little bit, it's a good way to shape the future, right?
But
it's happening.
Yasmin, if I may also add, there is also a very strong need for us to internally ensure that whatever response we give out to the industry, it stands the test of time. So we won't have different teams talking about different things over time. And that's another reason why it's so resource intensive, because we have to build in the internal system to ensure that we have consistency in our chat room sessions as well. But technology is helping. We're developing AI engines to look at what we are talking to the
Arthur,
industry.
Let me ask you. Sorry, I'm going to take over. Let me ask.
Feel free.
let me ask you about the reviewing of these regulations, because I think what's needed, and thank you for that input. Because at the dinner yesterday, there was a lady who was speaking. I think she was on behalf of Canada and the UK. Excellent speech, and she was saying that her supervisory regulatory groups are also getting people in a room, understanding the technology, seeing what is needed, and then applying where needed. Are you constantly reviewing these regulations so it's a flexible regulation, allows short-term review?
Well, as I've said, our requirements in terms of DLT and AI and cloud are actually very principle-based. So through those chat room sessions and what we call fintech supervisory sandboxes, we actually get inputs. So we can keep reviewing whether there's any new use cases popping up that requires us to fundamentally revisit the principles that we have set out. So far, no. Actually, I think the principles are still very much intact. But that's a good source of inputs for supervisory simplification, if you use the word.
So my impression is, Ray, you would like the idea to see kind of regulation like this in Europe as well?
Well, I think the interesting thing, what we're learning here, is that you can't be rigid. You can't just put in a block of rules and hope it works without constantly working very closely with the industry. That doesn't happen, unfortunately, as much as it should in the development of these new digital regulatory policies, right? The regulators in the banking sector, right? And I love this because when there was a whole financial systemic meltdown in 2008, the ECB, the EU, the Commission, they came in there, they saved the economy. You have the single resolution board that's effective, that works, right? So this is an instrument that understands intuitively how markets and economy and banks work. We don't have that for AI. No one knows. It develops at such a fast speed. You need the time for A, to develop it, B, to implement it, C, to create this level 2, level 3 implementation, the standards and rules and guidelines. So yes, that is very much needed. Slow down, simplify, understand where the market's going, because if it's too heavy hitting, if we get, too concerned about what could happen, what may never happen, if you look at all the predictions of AI, it hasn't delivered, or it's delivered in a completely different way. So we have to understand this very closely and work closely, with the regulatory bodies and supervising authorities. Otherwise, what you may have is, as I said, fragmentation, but even worse, you're telling the supervising authorities, to take a huge amount of data and information and implement. They don't have the resources, skills, or ability. They will be overworked and they will struggle. So
unless they use AI. Maybe they invest in that as well.
Yeah.
So, but let's see if this is matching the impression, our discussion of the audience. So do we have the results of the second poll? I would be curious about it. Okay, obviously the views shared that it is too detailed and prescriptive, but very close. It provides a reliable and helpful framework. So you are regulated more principle-based. So would you like sometimes a little bit more prescription in regulation, that you have a safe framework?
Well, I think it probably depends on the situations. I think in general, just for the avoidance of doubt, principles doesn't mean there are no rules. And so that's really important, right? It's always about a bit of balance. So in fact, the rules are clear. I would say the rules are very clear. And, but the principles gives you the ability to evolve in time, especially when there's high innovation, to adapt. But you do need to have boundaries are very clear, I would say. I think I would differentiate though. There are things that are very clear, stable right now. If you think capital rules, right? At the end, you need clearly rules, specifics and so on, because it's very clear what the framework you're dealing with, what are the requirements, what is the trust and the minimum safety net you need to put. So on that side, yes, you do need very detailed and prescriptive, really, rules of the game. In some areas, I think it's like AI or things that are still developing, it's probably very difficult, so you can put some broader boundary, cast a net, but then effectively you need to grow together, the industry and the supervisor, I would say. But yes, for us it's working very well, the type of regulation we have, and the engagement with regulators works very well. I would say the important thing, maybe as an overall meta message, is that we should not forget that regulation, so to preserve, the safety of the financial system. So there is regulation, which is mostly policy, but there is supervision. And supervision really is really important. And that's when you get the engagement, that's when you get the flexibility, then when you get together to understand what's happening. So I think more than rules vis-a-vis principle, I was encouraged everybody to think that the toolkit is broad and includes the rules, the policies, but includes also supervision. And supervision is where sometimes you can get into more fragmentation or more difficulty, right? So that is a very important toolkit as the world evolves, because that's where the regulators can work side by side with the firms. I don't know what's your experience, right? And a lot can be achieved in that space as well. That would be my
But honestly, if you look at that response, in the world of supervision, we always have this saying that if half of the banks criticize you and half of the banks support you, you're about right. So that shows that the European regulation is about right. I think.
Yeah, but well, you're for sure not in Hong Kong the ones who are too detailed and prescriptive, as you showed what you are doing. So my question would be, being the other half of the banks then, how do you ensure that the system still is safe if your rules are so agile?
Well, first of all, when we test it out, we do insist on banks having a representative enough sample of customers joining it. So not really just trying it out with 5 or 10 customers, but you have to have a representative enough, a statistically significant sample. When you scale it up, then you would need other sort of risk considerations to be put in. I actually went back to our database to see whether there has been any banks which graduated from the sandbox or they came to a chat room and subsequently getting into big troubles. So far, no. We haven't actually come across those kind of cases. Mm-hmm. So I think it's doable in practice, although it's seemingly very agile and not really very certain upfront. Through ongoing dialogue with them, you can actually scale it up without getting yourself into big trouble.
Yeah. Yes, let me add also, I don't want to give a false impression that industry doesn't like regulation. It's just not true. And if you look at that response, I think people get confused because they're not being asked if these regulations are good or bad, right? So I think everyone in this room, if you're industry or if you're a regulator, will say we need those rules, right? We would not have a banking system if we didn't have regulation. I would not be giving a stranger all my money if there wasn't regulation. The question, though, is, and I think if we ask that question, is what are the parts of these regulations, right, that need to be put in? And maybe it all has to be put in, but it's a lot. And I think it's that message that we heard in the opening keynote. It's about streamlining. So I'll just pick one regulation, the Payment Services Directive 2, right, the PSD 2. There's many different parts of this that is required if you want payment services, to happen in Europe. But with this regulation, there are 6 mandates for technical standards. There are 5 mandates to develop guidelines. There's 240 legal requirements now to create Q&As. This is going to take time. Right? And maybe there's areas of this that have to be simplified and implemented. I think earlier I said it took 7 years for GDPR. My brain was ticking along. I think it's been more like 10 years. So, we do need the time to implement these things, and there's a cost that's going to be required, and you need clarity. Because many of these different regulations, like the AI Act, for example, there's a lot of the definitions and scope and requirements of what is high risk that's just not clear. So I think this is what is needed.
Okay.
Yasmin, if I add to that, we put a similar question to banks regularly to ask them, what do you think are the major challenges for innovation in your bank?
It's also 50-50 the answers?
No. In the latest, we didn't ask them about regulation because if our rule is that if you won't like the answers, then don't ask the question. So we put it in a slightly different way. We asked them, what do you think are the major challenge to innovation? And we do have a regulatory framework in there. The top challenge that they face is actually what they mentioned, cost of implementation. Regulatory framework only came in like the 6th item down there, with only about half of the banks saying it. But 75% of the banks were quoting cost as the major consideration. Other things like legacy system, they did mention it as the third highest quoted challenge. Data privacy and cybersecurity, 61%. That's the fourth one.
I feel compelled to add to this. Thank you for sharing, because this actually resonates a lot. And I would like to share also the other perspective, which is actually, I was very surprised to see regulation as one of the items even there, because in reality, sometimes we experience the opposite. I'll give you an example. You mentioned PSD2. PSD2, which translated in the UK into open banking, and now it's becoming open finance, has been one of the biggest triggers for innovation, disruption, and competition in the market. So open banking is today, reality is kind of unlocked the development of a new business model. A lot of new companies that are today unicorns have grown up because of that, just to enable the open banking exchange of data. It has completely opened up to competition in terms of new smaller banks and a smaller player being able to operate on a level playing field with bigger banks. Customers having a much better convenience, and ultimately, we're forgetting to talk about the customers here, but everything should be a means to an end, right? And getting a better experience. And right now, this is leading to a private and public partnership between the industry regulators and really the government to move to the next level. They will probably develop new revenue models and new revenues new business model for the industry, but affecting new services for customers. So I think that's been very, very good sometimes. And similar in some situations, if we don't have regulatory clarity, we cannot innovate. And I really think that's really important. So we've had some dialogues in the last few months, for example, about the new innovation that's happening around about stable coins. And it's impossible to move ahead unless you have clarity on the regulatory guidelines and the regulatory where it's going. So I think it's important to keep both sides of the coin in mind, just to reframe that.
Well, you mentioned the customer, and I think we haven't discussed this perspective so far on the panel. So we learned, I think it was your numbers, that less than 20% of the EU citizens have a high level of financial literacy. Now, digitalization is going on so fast, so that I question myself, do we lose 80% of potential customers? Because, well, nowadays we have high-level criminals who have a high literacy rate, I would say, on financial terms. So how do you deal with that? So do we lose a lot of customers and they lose all their money because...
Well, I would maybe split the problem. I didn't know about these stats, but happy to elaborate on that. So
it's your commission, by the way.
Okay, fine. I get it. So I would maybe talk about two things. First, just talking from Robert, right? So really to get some facts about what is really the customer base we're talking about, right? And then second, about what you're saying, which is effective fraud, and could there be, what are the most negative outcome of that? So on point number one, I would say that sometimes when you think about innovative players or digital banks, we might think, in general, people think these are targeting like young people, right? 18 to 20-year-old. That's not true anymore. So in reality, if we think about customer base, the average age of our demographic is 38, with big tails on both ends, but not really a lot into the 18 and 20. In fact, that's the areas where we have a problem growing, right? So I think it's, so first of all, digital adoption is more widespread across different ages and different sides of the demographic than we probably think. But very happy to discuss that, what you mentioned. So there's already, in terms of coverage, in terms of addressable market, it's very wide, and it covers, even older or size of parts of the population do adopt and use digital and mobile. The second thing is, however, we are aware, for example, from a Revolut side, that not everybody has the same digital skills and do an extra effort in terms of education, but also service level. We do have this categorization in Revolut about customers that we think they're kind of one way or the other vulnerable customers, and then there is a specific ways to reach out to them, ability to offer more direct in-person calls and things like that, right? So there is differentiation in terms of we're able to differentiate between people that need different levels of a different level of digital adoption. I think separately from fraud point of view, I think it's true that fraud is one of the biggest problems that we have right now as a societal challenge. It's not just a financial services challenge. In UK, it is the #1 crime. But I would say it's a more broader, I think that the focus should be on broadening out what this impact is across all sectors, not just, it requires, across industry segments between technology companies, financial services, and also, social media in a way. So I think on that, if I had to say, think about the customer, there's a lot that can be done, and we could talk about this, about data sharing, share liability,
also, if
and
we
things
then
like that.
have quant computing?
Yeah, that becomes very difficult. So I think fraud, it's a bigger chapter, and I think it's not only related to people that don't have digital skills. I would say it's much broader than that, and the plan of action should be much broader. We're doing a lot of work on that internally, as I mentioned before, in terms of being ahead of fraudsters, in terms of the technology capabilities and how we much invest on that. But I think in general, what we found, and there are a lot of international experience there, is there are probably 3 things that matter. One is data sharing. Cross-industry data sharing that is done only in few countries. We know that in Australia there is a very, very big and very good agreement across all industry to share data. Because at the end, if you have a scam that is repeated 3 times, it's always the same, right? But we don't share data. Now it's very siloed. So there are a lot of private sector initiatives, for example, in the UK, to try to do that. They're moving very slowly, but giving a bigger push from a regulatory point of view, government point of view, data sharing will be important. Second, I would say, is share liability. Right now, in a lot of countries and regions in the world, financial services are held responsible. We do reimburse all our customers when there is fraud. There are regimes for that, but the truth is too late. We are kind of the last line of defense, but in reality, reimbursing doesn't solve the problem. You need to prevent fraud at source, and I don't think this is really tackled yet. And then thirdly, I would say, on the customer side, there's the need of a lot of education, because right now what I see is that it's very difficult. So for example, I know, because being a bank, I know what the other type of frauds are happening. You probably know as well, and I pay attention. And in spite of that, sometimes I'm targeted still, right? But if you don't know what to look for. And so I think we should, something is happening, for example, in the UK with different entities and trade associations about giving much more education since early age to everybody, what to look for, what are the risks, and this needs to ramp up, because everybody needs to upgrade their toolkit, right? And otherwise we'll all be exposed.
And
so
let me,
I think also
sorry, just very quickly, online safety, how you purchase and how you're not going to be defrauded, is not only the bank's responsibility. It's everybody's responsibility in this room, including the media, right? So everyone has this responsibility. Financial literacy is, who knows what a DLT is? Put up your hand. Who thinks it's a sandwich? Okay, very good. This room knows. But 80% of Europeans do not know. So this is the efforts that we need to make, right, as a government, as industry, both financial awareness as well as online safety, right? But banks actually play a huge role in protecting you. So I got frauded actually recently. It was very stupid. It's amazing that I've been in digital my whole life, but it happened. And the banks came into my aid. I had an insurance and I got reimbursed, right? So also now, and I love playing with this, I'm such a nerd, but the banks now, you can put in your IBAN number and check if it corresponds with the name. How cool is that, right? So, banks are actually there.
We're doing a lot.
Yeah, they're doing a lot, and everyone is responsible, including the consumer themselves, right?
Is the bad guy
But Ray, just to make you feel better, we actually look at the profile of people who get defrauded by online scams or online fraud. There's no linkages to financial literacy whatsoever.
No.
There are professionals who are actually in the financial world who get defrauded by online scams. So to debunk that sort of myth, it has nothing to do with financial literacy. The other thing is financial literacy, yes, we need to enhance that going forward. It's very important, but I thought COVID has done a part of that already. But most important of all, when banks develop technology solutions or application scenarios, they should really bear in mind that technology is not for exclusion purposes. Technology should be for inclusion purposes. If you deploy technology properly, you can actually enhance the services to, for example, the less digital savvy group like elderlies. There is an AI application being tested out in Hong Kong. When an AI engine communicate with elderly online, they actually look at the facial expression. Do they look puzzled? If they look puzzled, the AI engine would issue the command, slow down, and explain in clearer, simpler terms to the person and ask them, are you puzzled? Yeah. So there are things that you can actually deploy technology by helping people out that are less digital savvy to actually use the service better. Yeah.
Well, I promised that the audience will have the possibility to ask questions, and if there are any questions, please raise your hand. So,
Marko Pahor, Banka Slovenija. Since speaking of digital, stablecoins were mentioned briefly, but for the whole panel, what is your take on central bank digital currencies, and for Ray in particular, the digital euro, obviously?
Okay, all right, let me answer this question. I was told by my staff, be careful how you answer, it's the ECB, but look, I think what would be good is that we have, a lot more explanation about, stable coins, about the digital euro, and then to work, do we need this very fast? Can we do it, together with industry? Can we help you? And have a conversation about what it means to banks, what it means to tech providers, and then develop this together. And I think that is necessary. So I wouldn't come out and say, no, we don't want it. I think we just got to understand it better. And I would love it if the ECB would come to our big conference and explain that to our members. And then let's develop this slowly and understand what is required and what speed should we develop this. Again, regulators do not need to move at the speed of light like you have been doing. You can take your time to develop these things, particularly in these new areas. And I know we have to respond to different regions, but that'd be my answer.
Well, CBDC, if I may add, there are three different forms of tokenized payment solutions. One is CBDC, one is stablecoin, one is deposit tokens or tokenized bank deposits. We actually came out recently with a policy statement saying that we think that CBDC at the retail level, there's not much value add in it in Hong Kong. So we decided to go slow on that one. But we do think that at the wholesale level, in particular cross-border payment, it makes sense to continue to deepen our readiness for that. And so there are different ways of tokenized payments, but probably they are fit for different purposes. We have to find an actual use case that makes a difference.
You have any?
Okay. No, the only thing I would mention is that it depends. I don't think there is right or wrong. I think it's really important that it's very clear, the clarity of thought on what is the why, right? So the value and the use case, really, because I find that sometimes even in CBDC, there's a lot of discussion, should do it or not, without knowing why. And so I think it's perfectly legitimate that there might be different areas of the world that come out to the different conclusion because the why. But I think that's what it's the main thing is, does it really make sense or not for the specific area, what you want to achieve, right? And you've probably done your assessment in Europe, there are different discussions, UK, very different discussions. So I think that's the important thing, not to lose sight that this is a means to an end, and so you need to know what the end is, in a way.
So here has been a question in the second row.
I wanted to, picking on the, Lea Zicchino Prometea, wanted to picking up on the issue of financial and banking market fragmentation in Europe. And I was wondering whether for a bank like Revolut UK, the fragmentation in Europe is a challenge or it gives you an advantage.
No pressure.
You're on your own there.
Only on my own. No, it was really interesting to listen to the speech before where this topic was touched on. And I will maybe split the answer into two sides, and more macro and then revenue, right? So more macro, I think there's no doubt. I think fragmentation is holding Europe back, it's in my view. And this is not about us, it's about our ability to compete in a world where there are big blocks, where Europe as a whole could be as big as the US, but we're not, because we are still operating as a different country. So yeah, I think definitely is a very key area of focus. I'm very pleased to hear that this is being resurfaced as a priority. Hopefully there will be some solutions soon. For us, from a more regulatory fragmentation point of view, I would say that I would reiterate what I mentioned before about the difference between also supervision and then policy, right? So there is an harmonious regulation in general in Europe. The reality is it's very fragmented the way it cascades down in each country, and it's for us it's creating probably more a challenge than not, because we are, and I think in general probably it's true for everybody that wants to operate on a global or across border, right, international. We are a global company. We operate based on a global platform, and sometimes the same spirit of regulation has to be fulfilled in very different ways, and that of course does create a lot of challenges. So I think it's an impediment to growth we were discussing before, right, and to economic development, to growth, and so on. Because at the end, we put a lot of effort, and we have likely a lot of resources we can dedicate also to compliance, but the level of compliance specificities that's required today is massive, and so I don't think everybody can probably afford that. So I think it has two problems. It slows down the integration of Europe, which I think is key from a general macro goal, and second, it probably impairs a level playing field between big players and small players, because ultimately not everybody can follow through, and so you might have only a few companies that will be able to become more global, more international, which also is never good for competition, right? So this would be my
Let me jump quickly on this, because in my mind, I'm glad you said this, because everyone loses when there's fragmentation. Let's just be clear.
Yeah.
And even if you're in the UK or the US or whatever, the EU is a massive market. And if there's fragmentation here, everyone is losing. And one thing we didn't talk about a lot is cybersecurity, right? We have an instrument now in the DORA where there can be information and data sharing, across borders in the EU. Great step ahead. There is the financial services ISAC, where data can move very fast to counter cybersecurity risks and attacks, which are now being done by state actors. So we really have to step up the game. And if we're fragmented, then we're really going to hinder the resilience of EU and the financial economy. So, we definitely need to tackle fragmentation as an urgency. I think there was a lady in the back over there from the ECB who raised this, and I was kind of nodding my head. Yes, we have to tackle this.
So, are there any further questions? I see one here in the block.
Mark Schaltuper, I'm with Revolut Bank Europe. I wanted to pick up on something partly to what Francesca's answer was just now, but also what was mentioned in the opening remarks. The examples that Ray cited about Caixa investing 5 billion, Santander offering wealth management in Germany, it sort of struck me that we're talking about two Spanish or Spain-based banks in Europe. What about the other banks?
I did mention ING.
Fair enough. You did. But there were obviously banks that were not mentioned in this response. And I suppose the second part to that question is, in particular, it's sort of, I guess, the difference between innovating to disrupt and innovating to defend. And is there an advantage or a potential disadvantage for banks? Thank you.
I mean,
were you asking that to a specific person? Or?
The first part's for you, no?
Yeah. Look, I think innovation to disrupt is the most important thing, right? If I'm understanding your question. And banks that were very traditional, that fought back against PSD, are now the greatest benefactors of this, where they're working with fintechs, investing in them, and creating like all these great services. We've seen in our trade association, we have transport, we have healthcare, we have you name it. And it's been a wave moving through each sector. I think the finance community worked very fast. Revolut is a clear example of a disruptor, I would think. I don't know if you call yourself a disruptor.
Yeah, okay, I'm happy to build on that. And so I think there's a massive difference in a way to disrupt or to defend. And I think that's probably what we've been witnessing in the last 10 years. That there are a lot of new players coming to market, like us, to disrupt. So genuinely coming in with a view to play to win, to disrupt, to build the future of financial services. And the industry, as originally, because I was part of the industry, so I'm old enough, I can talk about this, the industry originally was skeptical. I remember we were at Barclays where we were still thinking that it would be impossible forever to onboard a customer without seeing him in person, really. And this was not 50 years ago because I'm not that old, but we really thought it would be impossible, so all these new startup, new players would go nowhere effectively. And today, this is the norm, right? So I feel that banks, until the last 10 years, have probably been reacting once competition has created a real challenge, only after that's created a real challenge. And then when you play to when you innovate to defend is always marginal, it's very difficult that it becomes a real disruption. I do think right now we are, however, at a pivotal moment, and different banks will take different direction, where there is the possibility to leapfrog. Some of the capabilities and skill set is also there in some of the big banks, not all of them. And so AI can give that possibility. So we might face a tougher competition now on both sides, but we need to see what's the level of adoption, right? But I think until now, the industry has been operating on new challenges, trying to shape the future, and so disrupt, and the industry mostly reacted. This is my 2 cents, very biased probably.
Just 20 seconds response. The line between innovating to disrupt and innovating to defend is actually very narrow now. It's a very fine line. We actually asked what we call traditional banks, they're not that traditional anymore. We have asked them to innovate themselves, to disrupt themselves by disrupting their existing transaction-based models into a database model. So we've been asking them to do exactly the same. We introduced 8 digital-only banks 5 years ago to start that process, and now we are bringing it to the next stage.
Yeah. So there's another question.
Thank you. Adam Farkas from AFME, and I will have a question following up this discussion, which would be on the basis of Revolut's example. Francesca explained that it was a company based on data, and now it's becoming a bank, and it was all. It is all based on the disruption was based on PSD or open banking. What is your view on the reciprocity argument of allowing banks, incumbent banks or traditional banks, having access to the data of the disruptors who are business models based on data and data aggregation and data harvesting, and allowing the banks not to defend but also to try to disrupt that space and be competitive?
Yeah.
And this is a question to the whole panel, but specifically you are in a
Okay, so I'll try to be quick. So first of all, I want to clarify, I don't see these two things being mutually exclusive at all. I'm saying that Revolut as a culture is very data-driven and will remain forever, hopefully, even as we now are a bank or become a bank in different jurisdictions. So I think these two things, and in fact, I think that has to be the foundation of any financial service company in the future, any banks or no banks. So I think the only thing is that Revolut was a bit more future-proofed the way it was built, because in the future, everybody will need to go in that direction. So to your question, can it go the other way around? I would say definitely yes, and I think it's happening, and I completely agree. And that's why I'm saying we are at a pivotal moment where we're probably shifting from incumbent and challenger, and we are all kind of now challenger. So, and the exchange of information, the exchange of best practices, and the exchange of people is happening both ways, which is massive, and I see that a lot. So people matters, right? This is all about capabilities and talent, a lot. And it's really difficult to find AI talent, software development, and so on. And right now, we used to see a lot of people going from banks to challengers and bring practices. Now we're also seeing people going from some of the big technology companies or big companies like us, sometimes back to the banks because there's a massive war for talent as well. So I think these two things are going in both directions, and I think that's welcome because this probably created more competitive tension, so better outcomes for customers ultimately.
So as we run out of time, short answers from the others?
Yeah, sorry.
Should I start? Just very quickly, Adam. The data that is most valuable probably are not the traditional type of financial data that we were talking about. It's unstructured data out there. And so that really, there's no proprietariness to those data when it comes to challenger banks like Revolut or our digital banks, our digital-only banks in Hong Kong. So it's open for all, I think.
Yeah, I really don't have much to add. I mean, I think the dialogue has to just continue because the market is constantly evolving, and you have the regulators engaged, and everyone's learning. So we just have to figure out what is it that's necessary, what is those gaps that are required, and then investigate that over time, I would say.
So this panel has been 2 minutes too long, sorry for that. But I thank you very much for your participation to the panelists, and thank you also for the audience in participating in all polls and stuff. So thank you very much.
Thank you very much. Thank you very much. And to disrupt this conference a little bit, I invite you to coffee and pastries outside. We will come back at 11:30 and strengthen your resilience, please. Thank you. Thank you very much. Welcome back from the break. I hope you're all strengthened and resilient. Let me introduce our next keynote speaker, Frank Alderson, the Vice Chair of the Supervisory Board and member of the Executive Board. The Vice Chair will speak about boosting Europe's competitiveness, resilient bankers, and simpler supervision. Frank, please.
Well, thank you very much, Connie, and thank you very much, all of you, for being our guests yesterday and today, and for all our panelists and speakers for having for having enlightened us so far. I'm enjoying myself, and I hope you will be saying the same after my speech. So, and it's a pleasure also for me personally to stand here. So over the past 2 days, we have discussed what resilience, that word has been used a lot, hasn't it? What resilience means in times of challenge, in times of complexity and disruption. And why resilience should be broad-based was a term coined yesterday, I think, by our chair. As she mentioned yesterday, broad-based resilience is about strong financials, but equally about operational resilience, sound governance, and good risk management. Now, during this period of profound change, a debate on European competitiveness has emerged in full force. Many are asking what the key impediments and main enablers might be for a more competitive European economy. How can we tackle the former and improve the latter? And what role does the banking sector play in shaping the competitiveness of the real economy? Now, the good news is that over the past decade, much has already been achieved to make banks more resilient. And this resilience remains the indispensable foundation to support the real economy throughout the economic cycle. And I will therefore start by illustrating this very welcome, healthy state of the banks under our supervision. At the same time, discussions about the complexities that are having an impact on European banks' competitiveness have gained prominence. And today, I would like to highlight how we are tackling undue complexities in the regulatory and supervisory framework in order to help banks operate efficiently within a predictable, proportionate, and risk-based framework. And I will then illustrate how banks' competitiveness crucially hinges on structural and macroeconomic factors that will require a concerted effort from a wide range of stakeholders. And in this way, Europe's banking system can be both innovative and strong, competitive and resilient. So let me first start by looking at the resilience that I have just mentioned at the start. Resilient banks are a precondition for a thriving real economy. Now, why is that so? Well-capitalized and resilient banks are better placed to channel funds from savers to borrowers to enable businesses to innovate, households to buy homes, and governments to finance public goods. Banks must therefore be well-regulated and well-supervised. The European Banking Supervision was established in 2014 in response to the global financial crisis and the subsequent European sovereign debt crisis. And now, almost to the day 11 years later, I should say, banks under our supervision are significantly stronger. Thanks to the regulatory guardrails, rigorous supervision, and continuous improvements in banks' risk management, the banking sector is now in a much better position to fulfill its essential function of supporting the economy at all times. Today's euro area banks have solid capitalization levels with a CET1 capital ratio of 16% compared to the 12.7% a decade ago. Banks have robust liquidity positions, well above regulatory requirements. and the asset quality problems that plagued many significant banks across Europe a decade ago have been successfully tackled. In fact, today, the non-performing loans ratio stands at 1.9% less than a third of the level observed 10 years ago. And I'm looking here at Sharon, I know you played a big role in that. Moreover, euro area banks' profitability has improved, with their return on equity now standing at 10.1%. Encouragingly, stronger profitability is increasingly reflected in the higher valuations investors attribute to euro area banks, as shown by a price-to-book value of over 1. And in addition to financial resilience, euro area banks have also improved their risk management and governance and boosted their operational resilience. And thanks to broad-based resilience, banks have been an anchor of stability in undeniably challenging times. The 5 past years, and it has been said before, but let me just summarize, or try to summarize a little bit. The past 5 years alone, we have dealt with the worst pandemic since the 20s, the most devastating war on European soil since the 1940s, and the biggest energy shock and rise in inflation since the 1970s. Moreover, we are now seeing tariff levels and beggar-thy-neighbor trade policies reminiscent of the 1930s, and a resurgence of a great power rivalry similar to the Cold War of the 1950s. All while the climate and nature crises are getting worse. Against this backdrop of change and complexity, the euro area banking system has fared well. Banks remained resilient and did not propagate shocks. And this is no coincidence. Well-capitalized and resilient banks do not excessively retreat in downturns, propagating adverse dynamics. Instead, they continue to support the economy. Think about what happened in the pandemic. Banks continue to supply credit to struggling businesses and households, even in the direst of circumstances. Better capitalization, therefore, makes the banking sector more resilient and better able to fund the real economy in good as well as in bad times. Now, of course, fiscal and monetary support to households and firms clearly helped to shield the banks from higher credit losses during the pandemic. So resilient banks yield what I would call a double dividend. Not only are they safer and hence better able to withstand shocks, but they're also better able to continue playing their vitally important role of supporting the economy at all times. And in that sense, resilient banks play an important role in contributing to competitiveness, especially in a bank-based economy like Europe. Now, at the same time, we are hearing voices loud and clear about undue complexities in the regulatory and supervisory framework that may negatively impact on banks' competitiveness. And looking how the regulatory and supervisory framework evolved since the start of the banking union, there is undoubtedly an increase in size but also complexity, which is shaped by several factors. A root cause of this complexity lies in the persistent fragmentation of rules at national level. Many facets, actually, of the current prudential framework, for example, do not actually consist of a single European regulation, but of a patchwork of nationally transposed directives that create complexity. And in addition, foundational elements of the prudential framework, such as accounting standards, securities and insolvency laws, continue to differ across member states, which also add unnecessary complexity. Another root cause of this increasing complexity is that regulation and supervision have developed in lockstep with the complexity of the external environment in which banks under our supervision operate. For example, the framework has evolved to make sure banks are operationally resilient, for instance, to ever more frequent and severe cyber attacks and operational failures. And while this was very much warranted in light of the more complex external risk landscape, it has also led to regulation growing in size. And at the same time, there's also that need to identify areas of unwarranted complexity, overlaps, and unnecessarily prescriptive elements that may have built up over the past decade and which can and which must be simplified. And against this backdrop, we welcome the debate on simplification. And the ECB's Governing Council, it was mentioned this morning already by Minister Donohoe, has created a high-level task force on simplification to develop proposals to simplify the European prudential regulatory, supervisory and reporting framework while still maintaining resilience. And the task force plans to deliver its proposals for simplification to the Governing Council by the end of this year, after which they will be presented to the European Commission. And as far as European banking supervision is concerned, we have been taking action for quite a few years now. So let me outline some of the initiatives that are already in full swing to make supervision more efficient, more transparent, and more risk-based without sacrificing resilience. And this makes sure that we keep banks resilient in an efficient and an effective manner, and thereby reducing cost factors that may hamper competitiveness. And we are proving that simplification and resilience are not opposing forces. They can very well go hand in hand. So the comprehensive reform of the SREP process that we embarked upon in 2020 is at the heart of our simplification initiatives. We have embraced risk-based supervision through initiatives like a risk tolerance framework and a multi-year approach, which allow our supervisory teams to focus more effectively on the underlying risks that matter most. Practically speaking, what that means is that we are not looking every year at every risk in every bank. And the SREP reform is already delivering results. SREP decisions have become shorter and more focused, with SREP measures decreasing from 700 in 2021 to below 400 in 25, with a stronger emphasis on addressing severe findings. Moreover, issuing decisions by the end of October rather than the end of December means that key findings can be communicated to the banks more promptly. Elizabeth, I see you smiling. You were great in leading this work. We are also enhancing our supervisory planning by improving the alignment of different supervisory activities, which helps banks to avoid duplicating their efforts. And in addition, we are reducing undue complexities and prescriptiveness by streamlining our supervisory processes through our, what we have called, next level supervision project, which covers areas such as decision-making processes, internal models, stress testing, capital-related decisions, reporting, and not least, on-site inspections. One concrete example are our fit and proper assessments, where thanks to the help of machine learning and technology, we have reduced processing times so that banks receive our responses faster. And another example, talking about doing things faster, is a new fast-track process for simple securitizations, which was tested in the first half of 25. And this new process will cut approval times from 3 months to just 10 days. An additional concrete simplification initiative is our drive to reduce reporting costs by establishing an integrated reporting framework that is accessible to statistical, prudential, and resolution authorities. And we are also embracing proportionality, which, although of course already embedded in the European regulatory and supervisory system, can be expanded further. Currently, small and non-complex institutions, which are banks that meet clear criteria for size, simplicity, and limited trading activity, already benefit from lighter reporting templates and simplified liquidity and market risk standards, as well as streamlined recovery and resolution planning. In practice, that means that they are only required to report up to 30% of the data that large banks must report. And they also benefit from less frequent on-site inspections. Now, this small bank regime seems therefore a natural starting point to further enhance proportionality. For instance, one could consider a more systematic application of this regime, as well as an increased scope. And these steps could be taken while maintaining the single rulebook, which ensures the risk-based nature of the prudential framework is that the risk-based nature of the prudential framework is retained for all banks. Now, this is important because proportionality should not be mistaken for simply reducing prudential standards for all smaller banks, irrespective of the risks that this would generate. Instead, we should focus our attention on initiatives that reduce undue complexity, prescriptiveness, and cost factors without making banks less safe or causing them to lose track of the underlying risks. And in addition, while maintaining the current level of financial resilience among supervised banks, there is room to increase the predictability of how our supervisory assessments feed through the bank's capital requirements. And this enhanced predictability would help banks' capital planning. Moreover, the risk-based capital stack in the EU is admittedly complex. With up to nine different layers of requirements and buffers, each serving a specific purpose that needs to be met with going and gone concern funding instruments, the system can be difficult to navigate and at times create unintended interactions. Thus, there seems room to make the framework simpler and more transparent while maintaining resilience. Reducing undue complexities in regulation, supervision, and reporting that may hamper banks' competitiveness is essential. However, the ability of euro area banks to compete with other actors, especially with their international peers, is primarily shaped by a broad range of other factors, many of which are structural, as well as macroeconomic in nature. And this becomes particularly clear when looking more closely at the profitability gap between euro area banks and US banks. European banks, for instance, have a smaller home market and lower IT investments. US banks are more concentrated, with the largest ones operating across the entire country, which allows them to exert more pricing power and reap the benefits of economies of scale. European banks, on the other hand, do not have access to the same benefits because the single market is still fragmented. Moreover, business volumes and profitability crucially depend on a dynamic real economy. And as the Draghi report convincingly shows, real GDP growth in the EU has been subdued in comparison with US growth over the last decade. And the robust economic growth in the US, partially fueled by its more advanced capital markets, has provided substantial benefits to banks. Thus, improvements in European banks' competitiveness crucially hinge on revitalizing growth in the European economy. Another factor shaping banks' competitiveness is operating efficiency. And although euro area banks' cost-income ratios has improved from 66% to 54% between 2020 and 2025, since 21, this has been entirely driven by increasing revenues, most notably net interest income, showing that there is still room for improvement when it comes to banks' cost base. Considering the myriad factors shaping European banks' competitiveness, and the fact that many of these factors have structural and macroeconomic root causes, real progress requires a concerted effort by a wide range of stakeholders. So let me outline some of the potential avenues that can sustainably move the dial when it comes to banks' competitiveness. Now, one promising path for euro area banks to improve their operating efficiency is to enable them to reap the benefits of economies of scale by consolidating the highly fragmented sector. Larger pan-European banks would also be better equipped to diversify risks, invest in the digital transformation, and compete in higher margin, fee-based business areas. And such developments would not only strengthen banks' competitiveness, but also enable them to operate more efficiently in the most profitable segments of the financial market, improve their profitability, and optimize their liquidity management at group level. Now, from a supervisory perspective, we have repeatedly stressed that we see the benefits of cross-border mergers. And we have been crystal clear that we will not obstruct consolidation efforts, provided, obviously, that the limitative set of regulatory criteria are met. And these criteria essentially ensure that a merger results in the formation of a safe and sound bank. At the same time, the ability of euro area banks to build pan-European business models and scale up their activity is additionally constrained by the fact that the banking union is still incomplete. Completing it, including by establishing a European deposit insurance scheme, would help eliminate barriers that still hinder market integration and ensure that euro area banks can scale up and diversify geographically more easily. Some financial instruments can also play a meaningful role in transferring risk away from credit institutions so that they are better positioned to meet additional lending demands from the real economy, while creating opportunities for financial market investors. And as noted in the recently published ECB opinion on the sectorization package, the proposed regulations are a step in the right direction to make further progress at EU level to achieve economies of scale in the development of sectorization products, facilitate the expansion of the market, and support the integration of EU markets, all of which would broadly support the Savings and Investments Union. However, further integrating banking markets alone is no silver bullet for the competitiveness challenge banks are facing. Looking at the real economy, the Draghi report shows that the widening GDP gap between the EU and the US is primarily driven by weaker productivity growth in Europe. And when it comes to productivity, economists largely agree that one key reason for the gap is that Europe is adopting digital technologies more slowly and is unable to fully capture the efficiency gains of the digital transformation. Many firms remain behind the technological frontier. So in order to catch up, these firms need access to risk capital and to investors with the networks, the experience, which is why finalizing the Savings and Investment Union is so vitally important for more efficient and more integrated capital markets. Beyond capital market integration, the broader lack of a true single market further amplifies Europe's competitiveness challenge. As I mentioned in a speech earlier this year, internal barriers to the single market are, on average, equivalent to a tariff of 44% on goods and a staggering 110% on services. And soberingly, 60% of barriers to trade and services are still the same as they were 20 years ago. So in order to boost productivity, unlock competitiveness, and promote simplification, a time-limited roadmap to complete that single market once and for all is more important than ever. In areas where full harmonization is currently politically or technically unfeasible, alternative approaches, such as introducing a 28th regime, could provide a practical and an effective interim step forward. Let me conclude. Those three words are normally the most popular. Let me conclude. Europe stands at an important crossroads. To become a bulwark against external threats, to ensure our strategic autonomy, and to remain the masters of our own destiny, with good living standards for all Europeans, our economic prosperity is more important than ever. And to safeguard our prosperity, we must bolster our competitiveness to ensure that Europe is a place where innovators, where creators, where doers seek opportunity in what is still the world's second largest market. And if we are to succeed, a concerted effort by a wide range of stakeholders is necessary. And resilient banks have an important role to play. Banks that are innovative, strong, and at the service of firms and citizens at all times are an essential pillar of that competitive real economy. And as supervisors, our single most important contribution is to make sure that banks can continue to fulfill that vitally important role. So our job description is clear. Maintain the public good that is financial stability, because history has taught us, often in the hardest way during crises, that without financial stability, growth falters, progress fades, potential flounders, investment stalls, innovation slows, and confidence slips away. But with the solid backdrop of financial stability, there is no ceiling to the innovation, the progress, and the prosperity that we can unleash. Or to use Pascal Donohoe's wonderful image, there is no wall too high over which we can throw our heads so we can scale that wall. Thank you.
We are coming to our last forum panel, Finance and Frontiers, Geopolitics and Banking. The panel will discuss how worldwide fragmentation is shaping banking and supervision, and whether international coordination is a relic of the past. We welcome the moderator Martin Arnold and the panelists to the stage. Martin is the financial regulation editor at the Financial Times. He has covered all facets of the financial industry in London, Paris, New York, and Frankfurt for more than 2 decades. Martin will introduce the panel members and invite you to join the Q&A.
Well, thank you very much. It's a pleasure to be here. As mentioned, and until just over a year ago, I was based here in Frankfurt as the FT's bureau chief covering the European Central Bank. So this is, in a way, a bit of a homecoming for me. I'm now back in London and covering financial regulation globally. So this conference has been super interesting for me and has really been fascinating. So I'd just like to thank you, Claudia, and your team for organising this and for inviting me to be a small part of it. We have the honour of being the last panel, so we have to go out on a high, throw our hats over the wall of the challenges that are approaching us. And Frank's speech was, quite sobering in terms of the many challenges that Europe faces to achieve progress. Let's start, Claudia, with you. You gave a speech yesterday where you talked about many of these geopolitical tensions that the world is facing, and I know that the ECB is planning to do a reverse stress test looking at these geopolitical fragmentation and tensions and cyber threats, etc. How do you as a regulator, how do you go about addressing some of these problems which haven't yet materialized, but you can perhaps see some of them appearing on the horizon?
Thank you very much for the question. But before I answer it, let me say that all the praise goes to the team. So, as you said, this is really, they've done a lot of work to put interesting panels together. And I must say, I learned a lot myself. So thanks already now to everybody here. I said a lot of things already yesterday. I will come to the concrete question on how do we address geopolitical risk, because it's indeed not easy. It's not about risk. It's about general uncertainty, and we all know how difficult it is to capture that in our modeling, in our thinking. But let me first reflect a tiny bit, and I must say I have also a bit of a confirmation bias, as we I guess all have. When I think about what I said at the beginning of the conference, what I heard here on the panels, and a lot of the discussions were centering around resilience. I try to coin the term broad-based resilience, and I will say again in a minute what I mean with that. And then we heard a lot about digitalization. So, and both in some sense it's related to geopolitics, to globalization. That's a term we haven't heard here a lot, but it was the previous discussion. And I would say the answers that I've heard here about what is needed for banks also to remain competitive in a global economy, and what I've heard about resilience, again, and I would underscore what I said yesterday, these are not in conflict. So it's not like we either make the banks resilient and then they can, withstand all these geopolitical risks and uncertainties, or they have sustainable long-term business models and can deal with digitalizations. But a lot of the things we've heard here are really saying that these are, it's almost a double dividend. So if you make the banks more resilient, which means they have operational resilience, financial resilience, and have good IT infrastructures, that makes them resilient against geopolitical risks or uncertainties, but it also makes sure that they have sustainable business models, because you need, funding also for the long-term investments into IT, into cyber resilience, into fraud protection, into AI. So maybe if this is a theme we can take away from this conference, so what are the things that are good for both, for resilience and for competitiveness? I think that would be great. But you asked me something different. You asked what do we do specifically to deal with geopolitical risk and uncertainty, and we put our heads together. The supervisory board, the colleagues, we brought all the knowledge together last year when we published a framework for addressing geopolitical risk, because what we stressed is it's really a new, or not so new, but new for the past, let's say, decade or decades for most European banks. What characterizes this risk? It's really a risk driver of the traditional risk categories. And then we said, what are the channels through which geopolitical risk can affect the banks, the trade channel, the financial market channel, the security channel. And now we're working with the banks very individually. So this is also what Frank just mentioned, that we're much more targeted now also in our risk assessments, because we can speak individually with the banks where they affected the most, and the exposure can be very, very different. So that's one response. So we have this framework, we can go to the individual banks. And then, of course, we do stress testing, because all this is about uncertainties, and we try to shed light into the unknown future, and we have different ways also how we do stress testing. So there was the EBA stress test this year, common scenario for all banks, gave us a lot of information where the sector stands. But of course, we know that the common scenario is never the right scenario for an individual bank. So this is why we do reverse stress testing next year. We're currently rolling it out, discussing it with industry. How can we best do it so that we all learn from it? We did the cyber resilience stress test 2 years ago, so that was also very important. So these are all ways to deal with this uncertainty that we're all facing, and that I think was also a common message from the panels here.
Okay, thank you, Claudia. Daniel, if I could come to you as the banker on the panel. There's a feeling that, as Claudia said, that perhaps resilience and financial stability, there doesn't have to be a trade-off with competitiveness, and I think that's right. Everyone remembers the damage that was done by the 2008 great financial crisis, but still, is there a feeling in Wall Street and in the banking sector that perhaps the pendulum swung too far or after the crisis, and should it now be brought back to a certain extent in terms of the amount of regulation, restrictions, capital requirements that are on the banks?
So thank you for having me. It was obvious that after the financial crisis, there was a need of stronger regulation across the industry, and that happens. And that happened, and that has been helpful and create a financial services industry here in Europe or in the US and in many places around the world that is solid, is resilient, and we have tested many, many times in the last 15, 20 years, and it has really thrived and helped the economy. So, like everything, so sometimes you need to adjust a bit. And I think that this may be a good time where you want to see what portions of those regulations are keeping the industry safe, and at the same time, the industry, they put it in a position where the industry can contribute to economic growth and social progress. So there are some components of it here in Europe and in the US that is good to be reassessed. And I think that in this particular region, so Frank mentioned it before, in the last 20 years, so we lost a bit. The GDP of Europe and the United States were about the same in 2007 or so. So now the US is 10 trillion bigger. I was looking at a number the other day that there was some analysis being done, I think that it was MIT, and it looks at companies that started from scratch everywhere in the last 50 years, and now they're public companies that they are over $10 billion in market capitalization. The addition, when you add up all those companies in the US, the market cap is $30 trillion. Here in Europe, 450 billion. So some way or the other, something needs to be reassessed in this region to make the region competitive, because you have an amazing opportunity with 500 million people. So I think that the issue of finding the right balance and finding a balance that creates a good balance between the regulated sector and the unregulated sector, because at the end, if you want to have a sector that in no scenario has ever a problem, most likely will be a very small regulated sector, and it will create the sense and the reality that the unregulated sector, as we are seeing today, in private credit and private equity and private markets, sort of growing at a pace that is sort of reducing the size of the regulated sector as a percentage of the totality. So I think that the pendulum may have swung a bit much, but I think that it's very refreshing to see that both Europe and the US, they are focusing complying with international standards and simplifying to a point that regulation is effective, but it doesn't overwhelm the sector in a way that reduces the probability of that sector to contribute to the economy.
Okay, I might come back to that. I mean, that 10 trillion figure is extremely striking, and I I mean, I think if you look at the relative size of the banking sector in the US and the individual banks in the US compared to those here in Europe, the gulf has increased dramatically. I think the top 5 Eurozone banks would all fit inside JP Morgan quite easily. So
maybe
you know,
more.
maybe more. So that I think is a source of concern for regulators here in Europe. Eric, one of the things that, if I can come to you on this, you wear 2 hats, both as governor of Sweden's Riksbank, but also as chair of the Basel Committee on Banking Standards. If I could ask you, with your Basel chair hat on, how concerned are you about signs that these geopolitical tensions could lead to more fragmentation globally and less coordination, less cooperation, and perhaps reduce the level playing field that regulators have strived to achieve for the financial sector?
So let's start with saying that Basel Committee and all these international organizations, sometimes when you read newspapers, it's like they are dead, they're falling apart. They're not. So we're still meeting, everybody is in the room, all jurisdiction is showing up, everyone is very engaged. So I think that's a good starting point. And when it comes to the banking standards, the key here is the Basel III implementation. So of course, where we've all been waiting for the US to be direct here, that's what's been the case. And also what we have said from the Basel Committee is that let's get Basel III implemented, and everyone, including the US, has been supporting that kind of position. And I'm not a US citizen, I'm not sitting in the Congress or in the Fed or whatever, but if you just read the newspapers, listen to people in Washington, listen to bankers, I think it's very obvious that it's actually happening. It's actually happening. So there will be some kind of proposal coming out from the US. So coming back to your question, we're talking about the risk of fragmentation. We're actually going to more consolidation in the sense that the largest jurisdiction for banks, or for that matter for the economy, US is actually, it seems, putting out a proposal. Of course, that should go out for consultations and then into some kind of standard regulation. That might take some time. So that's the positive side. I think where, not to be too bright on this, I think realistically, this is not about, the organizations having hard time to find consensus. This is about different views in different important capitals of the world. And this is obvious for everyone. And as the Basel Committee is a consensus-based organization, that creates some friction, I think it's fair to say.
Your life has got more difficult.
For sure, and a lot of people actually tells me that my life is very difficult, so so thank you. But I'm trying to cope with it, and of course I get a lot of support from the Basel Secretariat and others. No, but honestly, I think on the non-bank finance, which was part of your first question here, that are we regulating the banks too much, or it's actually kind of leaking out to the NBFI sector? I think there needs to be an agenda on standards, also globally, I think, for that sector. And that sector is fragmented in itself because it's insurance companies and hedge funds, very different animals, right? So, but okay, let's say that there is issues here in that sector. That need to be addressed, typically from the FSB level, I would say. But for sure, there are also very strong interlinkages to the banking sector, which we have shown in reports, but many other organizations also have been writing about. So there is an element here of links to the banking sector, and it's very strong, much stronger growth in the non-bank finance sector than in the banking sector. So, and of course, you could then take the position that, well, it's not so leveraged, maybe it's a totally different animal. We have not seen a crisis yet. So maybe we don't need to do anything. I think, if you read what the FSB is coming out with, there's for sure an agenda to do something. But I think also, we should be honest, that's a fairly difficult landscape because there are different views from different capitals. It's consensus-based. So it's not going to be fast-moving, but I think it's moving.
Okay. Claudia, would you like to just comment on that and the risk of you know, or the difficulty in trying to maintain a level playing field when there are such different views, particularly on each side of the Atlantic.
Yeah, well, I mean, actually what I wanted to say that actually what Europe is doing is actually making hopefully your life easier, because I think Europe is implementing the CRR3, CRD6 from this year on. And so this is with transition periods until the early 30s, and you know, the different elements are phased in over time, and there's some temporary deviations. But I think when we look at what is the effect on the sector, we actually see that we have the data coming in also from the stress test, so they give us additional information about the effects of Basel implementation in Europe, and the evidence is very clear that the sector is well able to deal with the Basel rules. So it's in terms of the capital needs, it's actually there hasn't been an increase in capital requirements from this year on, because there's also the transition period. So I mean, this is I think Europe is implementing. Many other regions internationally are also implementing. I do think, but maybe it's for the private sector to say itself, I do think it's in the interest also of the big global US banks to have this common guardrails and a stable framework. And so I'm also on that part, I'm really optimistic that we find a way, that the world finds, the Basel Committee finds a way in the different countries, so that Basel is implemented. I think the one issue, and this was touched upon, where I'm more concerned and where I think we also need to go further and find international consensus, is what to do with the growing non-bank financial intermediation sector. So we know that some risks have moved there, may partly lead to a better allocation of risks globally, may also lead to increased financial stability risk, because also there we have pockets of leverage, of liquidity mismatches. And I think there, first of all, we need better visibility, so we need better reporting from that sector, so that also for the risk management of the banks, by the way. So we did very good work with some of the banks we supervise, and they sometimes don't have sufficient visibility for their own risk management. So that's where we also need consensus, reporting adequately, addressing also through regulation risk to financial stability. So it's not that, you know, Basel is a done deal, but I'm quite optimistic that we're getting there. But we also need to move on, because the world is evolving.
Yeah, we haven't seen the updated proposal on implementing Basel in the US from the Federal Reserve yet. So it's difficult to comment on it, Daniel, but you're here. Let's take advantage of that. You're a very senior, very experienced executive at the biggest bank in the US. And I remember a couple of years ago, Super Bowl ads were being taken out by the banking sector in the US, lobbying against Basel Endgame, which was going to push up the cost of people's shopping in supermarkets, and it was going to be this terrible thing. So, you know, are you happy how things are shaping up, and are you confident, and do you want the US to implement Basel in a way that was faithful to what was agreed originally all those years ago?
Totally. I think that every bank in the US, particularly the big banks, want to get Basel III being implemented once and for all and move on. And the most important thing that is in line with the Basel proposal and creates no fragmentation and is consistently more or less applied around the world. The reason why banks were a bit taken back in the Michael Barr's interpretation of Basel III is because it was the worst version of gold plating. If you look at, and I'll give you a couple of numbers so to illustrate this. JP Morgan, if we would have implemented Basel III in the way that version 1 of Michael Barr, our capital would have increased for the same activity around 25 to 27%. After the non-recalibration of GSIB and SACCR would have already increased by another 20% from 17 to now. So, and then the last version that to put CECL in SICAR would add another layer. So from the activities in 17, where we're perfectly fine, to if it would have gone that way, it would have essentially increased the capital for the same activity by 55, 60%. So we did at the time the analysis of looking at the way that Europeans were looking at Basel III and what would have been the effect of JP Morgan. And the number was very simple. It was essentially either a zero increase of capital to a small reduction. So now we are looking at what we know. There is a meeting of Mickey Bowman meeting the CFOs of the big banks sometimes in December. We will get more clarity. But what we are hearing is something that is quite aligned with interpretation of Europe, with some recalibration of GSIB, that more or less will keep the capital relatively flat to what it was. So in our case, that creates a situation where we have about $50 or $60 billion of excess capital because we were prepared for the worst scenario of Michael Barr's interpretation. So I think that that's what we think, but we will see when the rule is out.
Just to clarify on that, Daniel, when you say to keep the capital relatively stable to where it was when?
Before the current rules, without the $50 or $60 billion that would have increased by applying the Michael Barr version of Basel III Endgame.
Okay.
And in line with Europe.
Yeah. Can I just ask you, Eric, do you think that there is, I mean, you talked about there the massive amounts of capital that's going to be freed up for JP Morgan. That I can tell you.
It's free now.
It's free now. Well, yeah. Well, you need to see the final rules, obviously, before it becomes truly excess capital. But there could be a reduction of the GSIB buffers in the US. So there could be further reductions in the capital.
Yeah, but that gets compensated by operational risk capital. More or less, it's all more or less stable.
Okay. Well, there was an estimate from Alvarez and Marçal that all of the reforms that they're expecting to see would free up $150 billion of capital for the US banks, which is $2.6 trillion of lending capacity. So that's when I speak to European bankers, they're pretty terrified about that because they think that this is going to be, JP Morgan is already and big Wall Street banks are already growing much faster than them and dominating in capital markets. So there's going to be an intense lobbying here in Europe to weaken some of the regulatory standards here. I can almost see it coming. Do you worry about a race to the bottom?
Well, that's why we have the Basel III and that kind of regulation. So I did worry about race to the bottom when we didn't see it coming. There were more questions about what was happening to the Basel III. But I think on the banking side, I'm not overly worried. So let's take some of these discussions that's now going on. So the gold plating in the US with the ads on the Super Bowl, it should maybe be against not maybe the Basel, but maybe some other organizations, because we were not gold plating. We were, basically proposing what was said here. So that's a little bit strange. So I think the gold plating, some of that might be, relevant for jurisdictions, fine, but it's not the Basel regulation. So that's one thing. The other thing is the simplification part of it. So it is complex. I think our regulation has gone from like 400 pages to almost 2,000 pages, right? From Basel II to Basel III or Basel I, whatever. So it's a dramatic increase. So it's more complex. But you could do, because I asked my staff about, some of the ideas that have come out from the European system, and Frank was discussing this high-level group, and there's been some announcement of where you're heading on that. And most of that is totally Basel compliant. So basically, the complexity doesn't really come from the Basel system. It comes from the different jurisdictions. So I'm not overly worried about the race to the bottom on the banking side. For sure, we will get lobbying. But I totally agree with what Frank said. Banks' lending capacity, to some extent, for sure, is related to capital. Fine. But it's much more related to running the business in a profitable way, having possibility to M&As across jurisdictions within the Europe. And within Europe, and now take my Riksbank hat on, the Nordic banks, it has been extremely profitable through this 10, 15 years. And
very high capitalization.
Yeah, very high capitalization and still extremely profitable, whereas some banks in continental Europe has not been, and the same regulation, right? So, it's a lot of other things playing in rather than the capital. to end your answer to your question, where there could be a worry about the race to the bottom is in the MBFI sector, because there are some firms in various sectors, again, it's fragmented in itself, where it's truly global and where we don't have any global regulation. It's not really the Basel Committee to handle, but I think there is implication for the banking system. So there I could be a little bit worried.
Okay. Claudia, do you want to come in on this?
No, I agree on the regulatory part. I mean, this is what I said earlier. But let me say, I mean, what's the economic idea behind this? Why could there be a race to the bottom? And the idea is sometimes, well, if we lower the standards, then the banks, then we free up capital and then the banks can lend more. And I just want to say that it's not like we are locking away the capital. No, it's not like this is money that can't be invested. So this is equity capital is a very important funding source for the banks, and it actually makes them stronger. They can lend more. They can take risks better. They can also make the long-term IT investments that are needed. So I think we need to also work on this narrative that as if we were locking the capital away and then it needs to be freed up. That's just not the case, and we've seen many studies. I think also Frank mentioned a few of them, and there's been very consistent work also by the Basel Committee, by the Financial Stability Board, really taking a holistic picture of all the reforms that have been put into place, looking at the best evidence that we have across institutions and supervisory authorities, central banks, and looking at what happens when banks are better capitalized, can they lend more, are they more resilient? And that evidence is very clear. So I think collectively we need to keep updating the evidence because, of course, I mean, the world around us is changing and these underlying economic patterns may change. I doubt they would, but it's always good to also look at the data. But the evidence is very clear, and so I think that also, I know I've been saying this before, many in the room have been saying this before, but I think this is also important to inform that debate. So that's the content part, and also we have some safeguards, of course, around it with the Basel rules, as we've just discussed.
Yeah. Okay, Daniel, if I could come back to you, just as you're scanning this current climate, the current environment, and you're looking at risks, as every good banker is doing and every good regulator is doing. What are your views on the current state of financial markets and valuations in markets, particularly driven by the AI boom and all the excitement around AI? Do you think that there is, as Alan Greenspan once said, irrational exuberance going on here? And is there a risk of a bubble that could burst and cause some kind of crisis?
Well, so let me first make a comment on private markets, because I think that's one of the areas of concern. So, and I think on that one, I agree with the comments they made. But in my view, so you have two pieces there. You have the insurance piece and the fund piece. So I don't think that in the fund space there is a capital arbitrage. So if anything, they are leveraged around 1.5 times. That is similar, or it's slightly less than what an equivalent loan would be in a bank. So, so from that, there is no capital arbitrage. On the insurance side, there is a capital arbitrage. So when you put certain loans in an insurance framework that is more risk-based, as you compare the standardized in the US, so those loans, either very good quality or no securitizations, when you tranche loans and portfolios, and you put it in the whole risk in a portfolio in an insurance company will consume a lot less capital than in a bank. So there is some capital arbitrage, but it's not all of it. So I don't think, and this is our funds, that they are 7-year funds, the average loans are 2 or 3 years. So it's unlikely that that is going to create a systemic risk in the short term. I'm concerned about 3 issues there. So number one, as more and more money comes into the space, so the lower of credit standards and increasing leverage. So number 2, retail distribution. I think that at the moment it's more an institutional business. Every single credit fund is looking into retail. Retail people think that if you buy a fixed income asset, you will get your capital back and plus the interest, and may or may not be. in this case. And third, so this industry hasn't been tried through a cycle, a downturn cycle, because in the case when COVID happened, it was all subsidized by the government in the different countries in the world. So how they are going to, because these funds, the only relationship that they have with that borrower is the asset, and they are fiduciary to maximize returns. So how they're going to behave may be fine, may not. On other sectors, and you touch on AI, I think that what is a bit concerning to me is the pace of investment. And that pace of investment creates a capacity that someone has to use, so pay for those services. So is it possible that that investment could be matched with demand for services and equivalent in the relatively near term? In my view, it's very, very unlikely. And then you see big valuations on that, and big valuations in terms of historical multiples pretty much in every other sector, everywhere in the world, particularly in the United States. And the only way that you can justify that, one of the ways, is to think, well, all these services are going to create such an explosion of productivity that instead of being historical average in multiples, you can justify such an increase in multiple because of earning growth growing way above historical averages. Is that going to happen or not? Is unlikely in my view. I think that it will be a correction, that it will affect both sides, the hyperscalers and all that they are going to probably realize less of the investment that we're making, and probably the more traditional sectors, they are going to find a bit slower amount of productivity, so therefore may not justify this sort of a very high valuation. So it may or may not happen. I think that the markets will continue to thrive if the economy doesn't go into a recession, and I don't think that this AI situation will play out in the very short term, but it's something that you want to keep an eye on.
Yeah. Talking of keeping an eye on it, Claudia, does it seem incongruent to you, the level of valuations and the way that the market is pricing in, this great, bright, AI-driven future, and yet at the same time, all of the risks that we've been talking about, geopolitical risks and others that you worry about, and let's face it, not great stellar growth that we're seeing at the moment. So how do you deal with that, and how do you address that risk of perhaps a bubble?
Okay. Well, first of all, let us all take note that, this great innovation that we've been talking about now for 1.5 days has happened in the current, global regulatory framework. So this is probably not a very scientific statement, but it says that maybe the framework is not all that wrong, but it still allowed, this innovation to happen. Do I know whether there's a bubble or not? If you can't really, pin it down. So, I'm not in the business of saying whether or not there are bubbles. I think this is the similar question we used to receive about the housing market. Is there a bubble or not? And I think we are not in the business of, saying yes or no. There's lots of uncertainties. There's certainly the issue of whether, and I think you've said it very nicely, whether all this investment into capacity, into AI, new technologies, whether it then reaches actually the improvements in productivity that are also needed in the real economy. And I think for that, more is needed. And this is also, as my reading of the Draghi report, for example, that Europe clearly needs the single market, so that also these investments can be scaled up, and that the benefits of the single market can be reaped. I think it also needs more equity finance, so also risk capital. So apparently this investment happened because there's deep pockets also of the firms that are investing into this. But in order to be rolled out to the real economy, I think that's also what is needed there. So I think there's also complementary policies that need to be put into place so that this is all being effective, including also labor market policies, because there's a lot of adjustment that probably also has to happen on the labor market. And the question is whether that can happen without creating frictions. So all these are things which are not for the supervisor to decide, but for the policymakers. So
what about your focus on the banks?
What do we do?
Yeah.
Well, I mean, this is, so in the end, we don't know. We don't know whether there's a bubble. We don't know whether there's whether the right policies are forthcoming. So there's signs that there's overvaluations in these markets. That's what the analysts are telling us. And again, it all comes down to making sure that the sector is sufficiently resilient. So against, potential changes in market valuations, which can ripple through the system. So this is why we're so concerned about, keeping the resilience in the system that we have. And then very practically for the individual banks to make sure that they have sound AI strategies that create sufficient operational resilience and all that. So this is clearly our agenda. So resilience along all these dimensions and making sure the banks can safely navigate this.
So let's be clear, bubbles in general are driven by massive excess of leverage in anything. So I don't think that this is the case at all. This is a case of creating a capacity that it may take a while to be absorbed.
Well, the dot-com bubble wasn't driven by leverage, was it? It was driven by exuberance about the internet.
Yeah.
We also, we must admit there's also uncertainty where are really the linkages in the financial system. So this is the point I made earlier. So we can all keep our fingers crossed that there's not pockets of vulnerabilities that can spill over, but we just have limited visibility.
So could I just add, so what, I don't know, nothing to add on, what you're saying here, but if you have this risk on kind of markets that we have now, I think there might be, surprises that we don't like in, private credit, in, different corporates. So there might be accidents. I think that's clear. I think the big question for me and Claudia, maybe for you as well, is this systemic? And I guess you don't know, but I think there is some convincing argument that it might not be. But I think we need to look into it. I think the difference with this kind of maybe overvaluation risk on there might be something. It's very, very hard for a supervisor. I'm taking on my own old hat because I used to be a supervisor. It's very, very hard to go to the bank. So what do you think about the overvaluation? What should you do about that? No, the only answer then is what we're talking about. That's capital and liquidity. Because if you have not enough capital, you can handle a cyber crisis. You can handle a bubble in the AI sector, right? So I think capital is the answer. If we have more specific overvaluation risk, as we had in my country with the CRE, the commercial property market, then you could of course specifically ask the banks on their exposure, and of course we did. But I guess it's a little bit hard now. Maybe you could ask for some of these AI companies and the exposure there. But I think the answer is resilience and capital, and the risk might come and might explode somewhere, but we still have the resilience.
Can I just stay with you, Eric? I'd love to hear your views on we talked about private credit, and I think it's often referred to non-bank financial intermediaries, because that includes insurance companies, pension funds, etc. And it seems to me like there's a very different approach in the US than there is in Europe on this question of how to address the fast growth in this and perhaps some of the risks that are emerging in this area. The US seems to be taking the view that what's caused this is the pendulum swinging too far in the banking sector, over-regulation of the banking sector. That's driven this activity into private credit. So we need to bring down the level of requirements on the banks, and some of it will flow back into the banks. It seems to me that's the answer. But whereas in Europe, it seems like the answer seems to be that we're coming up with is let's regulate the private credit providers and require them to provide more data and put more restrictions on them. So very different answers. Do you think that is there a middle ground that can be found on this?
I hope so. I think it's a fair description of the case. I think I'm more on the camp that we need to do something on the resilience of the non-bank finance side in itself, but it might not be exactly the same tools that we use. So let's say the investment fund industry, there we might need more of gates and swing pricing and things like that, basically limiting the liquidity risk that we have.
Right. The liquidity mismatch is the big risk.
It's underlying liquidity mismatch, and if you then have a day-to-day liquidity, you know, then of course you expose it to risk, and we saw that actually also back in Sweden during the COVID crisis. So I think the saying should be like this, you know, bank accounts should be liquid at all times. Investment funds should not be liquid at all times. And, you know, when the weather is fine, sun is shining, they could be liquid. When it's raining, they should not be liquid. And to convince both retailers and institutional money that that's the case, and also have some regulatory, and there is regulation coming on in this case. And I think that some of these private credit companies, they're typically locked in money, right? So you don't have that liquidity. But if you would add retailers to this, there might be risk that you kind of get some liquidity risk also in this construction. So I think I would be in the camp, more the European camp than the US camp, but let's see where we end up in the regulatory world. I think the risk is if you lower capital on the banking side and start to hope that, you know, private credit will come back, well, it might be exactly the other way around. You free up capital, they start to interact even more with the non-bank sector. So the end game is a larger and non-bank sector and, well, same size or even smaller banking sector. So I think that would be a, you know, disregarding simplification, all that, but of course you could do that anyway, right? But to lower resilience in the bankings and then hope that that will bring back business, well, we should ask the private sector. Yeah, but I would be skeptical.
One comment on that. As I said that for the funds, not the insurance side, there is not a capital arbitrage. There is not a disadvantage for banks to be lending into that space. What these funds found, it was to give access to that asset class to a bunch of investors that the banks were not giving access to. We banks, we take deposits and we lend the money. So I don't think that there is a competitive capital disadvantage, at least in the US, on that piece. There is a bit on the piece that goes into the insurance side.
And some of those funds are buying loans off of the banks in order to sell them onto these. Yeah.
And at the end, this market will end up something similar what happens with the syndicated markets, because it's not a fund that's a loan and keeps all of it. They sell parts of it, and we do the same in the syndicated, and look at the flow. It sort of rotates between one place to the other. It was a huge amount of direct lending being done that then was refinanced in the syndicated space. So the two markets are kind of connecting quite well. And at the moment, I don't think that is systemic, but if they keep growing and putting more leverage and retail distribution and all that, so then it may be more systemic at the time.
Well, there's also linkages between all these sectors, so this is why I'm saying we just need to understand more. But I mean, just a fundamental question, this is in line with what Eric said, it's not that we want all the risks of the world to be in the banking sector, because I mean, there's different institutions that have different balance sheets, insurances have much more long-term liabilities. So I mean, this can also be a healthy allocation of risk in the system if other parts of the system are growing, but just we need to make sure that we understand where the risks are. So this is why I would, in some of these areas, start with reporting, understanding better. We had the same issue with crypto. No, when crypto started, we had no idea. It was private providers of information, often, you know, very unreliable information sources. So we also need to understand what this, where the risks are, what it looks like, and then also have regulation that addresses very specifically the systemic risk issues in sectors, and they can be very different, like Eric said. And I think Europe is actually having, there's a lot of good proposals on the table. So the Commission also has this review of the non-bank financial intermediation sector. So I think that for me would be the way to go.
Okay. I have plenty more questions, but I want, this is a great panel, and it's not often that we get such a high-level panel and opportunity to ask questions. So I want to, in the few minutes that we have left, I think about 15 minutes, I want to open up to questions. I think there might be a few. If you could raise your hand if you would like to ask a question. There are microphones, I think, at the back. Anybody? Otherwise, I will carry on quite happily with many more questions that I have. Anybody? No? There's a question here in the...
No, the topic was, the impact of...
Could you introduce yourself?
Marko Pahor, Banka Slovenia.
Yeah.
So the topic was the influence of geopolitics on banks, and it was touched and a lot, and talking about the reverse stress testing. Now, the reverse. Do banks still have an influence on the geopolitics? Because we know big techs have, right? So do banks still have it? And if we as regulators sense that they do have it, should we do something about it?
Wow. I think that's...
Above my pay grade.
I think that's a question for Daniel, isn't it?
Yeah,
How influential...
I honestly don't think that banks have an influence. We may have an opinion, but I don't think that we have an influence in geopolitics. Our job is to navigate prudently our companies in that environment, and clearly the environment is a bit more challenging than it was in the past, because everything in that front is changing. And then there are things that you know and you can deal with, like, for example, as an American bank with a big presence in China. So we do stress test our presence quite substantially. We have an amount of exposure. We have changed the liquidity of that exposure. So we have a size that we think that if something goes really wrong, it's not going to jeopardize the whole company. We do the whole analysis on the interconnection of us with every client and counterparty that could be more exposed to China than we are. And we do the same in the Middle East and other places. When you look at history, obviously geopolitical risk at the time is quite elevated. The geopolitical risk hasn't created a lot of market turbulence, so except with the oil embargo in the 70s. So normally, and even this time, with all the noise, the S&P still at the all-time high. So, but it's something that you want to really keep a serious eye on, because it's something that is evolving, and if worse comes to worse, you don't want to put your company at jeopardy if something goes wrong.
Claudia, do you want to respond to that?
So this is, of course, this is the short-term impact, and I think there we all agree. So given all the discussions we've had over the past years about geopolitical risk and what we've seen in the markets and effects on the banks, this has been very benign. But of course, it doesn't tell us anything about the medium to long-term. And colleagues here in the House have done interesting work on how this trade uncertainty could affect the banks in a more negative way. But just to on that question, so the reverse stress test, just for everybody here in the room, does not mean first we look at how geopolitical risk is affecting the banks and then we do it the other way around. Yeah. But it's rather about asking what specific geopolitical risk scenario could be detrimental for an individual bank. So because what we've done so far is just a one-size-fits-all scenario basically for all, and of course that gives us a lot of information, but not that targeted information that then also allows a good supervisory dialogue with the bank what to do about it.
So maybe something to add here. So I think that the financial markets in general, including the banking system, if anything, is kind of dampening some of the geopolitical risk, because we have this kind of bond market vigilance and all that, right? So, and you tell me, but I think some of the proposals that came out for the White House were changed when they saw the reactions from the financial markets, and I guess including the banking sector. And you could think of the Russia case, which is very kind of topical, sadly. So would that actually happen if Russia would have been a really strong player or a large player in the financial markets and in the global economy in general? Would they actually invade the country with all the kind of things that happened to them? I doubt it, but they were not that interconnected. They didn't have that large financial sector, so they could actually afford being isolated. Of course, there's a lot of other reasons as well, right? They're dictatorship and all that. But maybe that makes more sound policies for larger economy that are strongly interconnected, including the banking system. Philosophical answer, but I think there might be something in it.
Okay, we have another question. Adam. Microphone's coming.
Thank you. Adam Farkas from AFME. How does geopolitics or the current environment impacting supervisory cooperation? We've heard about the regulatory space, the Basel standards, the implementation of that. But for internationally active banks, supervisory cooperation is equally important and key. So I would like to hear your views from the Basel Committee, from a major supervisor, and also for a globally very active bank.
Okay, do you want to start, Claudia, and each of you?
Well, I mean, like Eric said already. So one aspect is, of course, the international fora where we all interact, cooperate. So I think this is going, I would say, business as usual with the discussions, of course, we have in terms of substance. But I think this is also what international fora are for, so that we come to the table, we have maybe different views to start with, and then we need to find common solutions. Exactly the same for our cooperation with the colleagues globally in all jurisdictions. So we keep up very good relations, and it's very clear to us that this is absolutely needed. And again, this is something that also the banks benefit from, because they want us also to be in touch and talk to each other in good times, and hopefully, more difficult times that would not come too soon.
The worst scenario for banks is a very fragmented regulatory system. It's just very, very difficult to manage. That you have one rules here and the opposite rules somewhere else. It's really difficult for every bank, small, medium-sized, or big. So
I'm not sure that's totally true, but I mean, certainly for a global bank that operates across, I don't know how many countries you're in, 50, 60 100. Countries, 100. Well, of course you want, harmonized rules, you want a level playing field. But for a bank that is broadly purely domestic, perhaps a mid-sized bank, they prefer some of these, this fragmentation. It kind of suits them, protects them, their market, right? I mean, I think I've seen that. Right, living here in Germany, I'm not going to name names, but there is a certain amount of protectionism that's driven by lobbying of domestic banks.
So when I was the supervisor, I get cynical now, but banks that said they would have a level playing field, I think that was a code word for lower capital requirements. But I'm getting cynical. No, I think, for the larger bank, I think you totally agree. But there's a lot of banks that are small or semi-small or regional that might be more prone to have like more regional regulation. But to your question, I think on the Basel Committee, I think it's kind of easier to agree and to move forward on the supervisory recommendations and things like that. We do guidelines than de facto standards, right? Because that's kind of has always been harder, I guess. But also, I think the geopolitics makes it a little bit more difficult. So I'm not saying it's easy, but if you grade the two of them, I think it's a little bit easier when it comes to supervision, because that's kind of less political in a sense, I think, in different jurisdictions.
Okay, there's a question right at the back over there. Thank you.
Hi, thank you for taking my question. Would like to ask for the view of all you three. It's a very simple question. Just whether the Basel rules should apply to all banks or just to some banks. Thank you.
Yeah, that's a good question, because there's a very different approach in Europe than there is in the US. In the US, the Basel rules, I think, only apply to the very biggest banks, whereas in Europe, they apply to all the banks, even the smallest ones. So, yeah, why is that?
I could take just the fact of what the rule says is that's internationally active banks. And then I leave the word to my colleagues. Because the implementation, of course, is very different in the US and Europe, for example.
Because there was a lot of talk in Frank's speech about proportionality. Wouldn't it be more proportionate to say only banks above, I don't know, 100 billion of assets should have to comply fully with Basel, and you could have a reduced regime for smaller ones? Just an idea?
Yeah, but I mean, there was actually one answer that I wanted to give to the previous question, because what we have in Europe is actually a very good showcase for supervisory cooperation and also overcoming this banking nationalism that you've mentioned, because we have the banking union, so we operate in the same framework. We supervise the most significant banks directly and the less significant banks indirectly. We have an oversight function there, and I think it's actually the European implementation takes that into account. I think it's a useful way of having the same rules in principle applying to all, but with a lot of proportionality. And this is also what is currently under discussion, whether there can be even more proportionality in terms of the compliance cost and so forth. But I think in general, this European approach to apply it to all, with also taking then into account some specificities of the European market, I think this is the right approach, and also helps us. I mean, we have the single rule book, so that's applying to all, so that's a great benefit of the banking union. But as been said also before, we're still operating with a lot of differences in national rules that are very relevant for the banks. So we can deal with this. We have very good experts who know all this, but it's also a very practical concern for many banks that want to go cross-border. So again, this is not about the banking rules, but it's many other rules that are not harmonized across Europe that are very important for banks and that may also impede the scaling up of activities and pan-European business models. So my answer to your question would be to stick to the general philosophy, let me say, of Europe, but then see whether more proportionality, more targeted regulation and supervision can be possible.
So in the US, I think that, so even if Basel III may or may not apply to the smaller banks, I think that those smaller banks needs to be properly regulated and be safe and sound, because we have seen what happened a couple of years ago.
Right,
so,
and Silicon Valley Bank wasn't
Silicon Valley
to
and First Republic. So, and the other ones, they were near misses. So Basel or not, I think that the US should look into that sector and make sure that those are not not by itself, but by contagion, create a systemic risk, as they did 2 years ago.
Okay. We do have a question in from someone in our online audience, which is great. They haven't provided their name, but so it's an anonymous question. But it's nice we're the last panel before the lunch and then the end of the event, so it's nice to end on a bit more of an upbeat note. So the questioner asks, the panelists, what you've said sounds a lot calmer than how the news portrays things. Perhaps that reflects badly on me as a journalist. But is the public discussion portraying things too bleakly? Claudia?
Well, difficult to say what this specifically refers to. But I think, I mean, what we've all said, we are concerned about also complacency and about, things, the short term, looks good, the numbers are good and all that, but we don't know what the future holds in store. I think this is a big message also from this conference. Yes, many opportunities if they're managed well by the banks, by policymakers, by us, but there's lots of issues to be concerned about, and we just need to manage that. And that's, I think, the key message here.
There is a bit of this alignment between the reality we see every day, all the challenges in the world, and market pricing. So I hope that market pricing is right, but there is a sense in there that is pricing a very, very good outcome and a bit more. So that is something that you want to really be focused on.
Yeah.
So I think, if you take the geopolitical tension, if you take the starting point with the Russia aggression to Ukraine, yes, I have one starting point. That's now what, a little bit over 3 years ago. Since then, capital requirements have been broadly the same, regulation has been broadly the same. So in that sense, you could be optimistic because we did a lot of good things after the financial crisis, and the banks are making money, economy is doing okay, and all that. The risk, I would say, to answer the question, is that if we just are fine with that and are not kind of agile enough to actually change regulation and react to risks that we see, which we talked about, retail in private credit, or there might be hedge fund activity in the treasury market, or there might be stable coins, who knows? If we are too kind of calm and don't, let's say we have an inaction bias, then we might have risks that are growing that we don't take care of. And that, I think, is a worry.
In addition to the fact, this is what I stressed yesterday, that the past shocks have to some extent been buffered by fiscal, also monetary policy. And this is the big question mark. Also, if you read the World Economic Outlook, the Global Financial Stability Report, there are concerns about the ability of fiscal authorities to keep solid finances.
Given where debt levels are.
Debt levels, yes, and so this could have an impact also on the resilience of the overall system. So that is something that also needs to be borne in mind.
Okay, not exactly a super upbeat way to end the event, but we tried. So we are perfectly on time. So all it remains for me to do is to thank our three panelists, Eric, Daniel and Claudia in particular, for organising such a great conference and for participating in what I think was an excellent panel. Thank you very much. Thank you.
Thank you very much. Thank you to this panel. And as was mentioned, we're coming to the end of our conference, and we would really like to thank all the speakers, the panelists, the moderators, for insightful and engaging discussions. And we would like to thank you, the audience, for joining us and for participating. And I would like to give some special thanks to ECB Representative Sharon Donohoe, who gave us a lot of input and insights and guidance in preparation for this conference. And one particular person, you heard her voice introducing the panels, Katrin Sander, who also led the team to organize this conference. So thank you very much to the whole team for organizing. So for those in the room, as said, there is lunch again in the Großmarkthalle, and my colleagues will show you to that room again. And from me, goodbye, and see you at the next forum in 2027. Thank you.